The Fed prolongs 7 out of its 9 emergency programs until year-end. In its latest effort to support the economy, stocks trade mixed ahead of today's rate decision. Bogged down, United States stimulus talks stall over liability protections for businesses as current measures start to run dry. Plus, trading boost. Deutsche Bank posts a small profit after its best FICC trading performance in almost 8 years. Matt, good morning.
Good morning to you, Anne-Marie. We see kind of a mixed picture with futures. We saw a mixed trade in Asia as well. Japan was down, China was up. U.S. futures are gaining across the board, but European futures are down. Let's take a look at the cash trade with the global macro movers screen on the Bloomberg terminal. You can see a number of risk assets here, but the left-hand column is the equity indexes. And as the indexes open up with the live trade, you'll see them pop up here in blocks. The IBEX in Spain just opening up 0.1% higher. The FTSE down 1/100th of 1%. So you can see that they're really struggling for direction. The CAC 40 in France gaining 0.4% at the open, but when the DAX opens up and the German benchmark index typically opens later than most of the others, you'll probably see a red arrow there. So European markets, Anne-Marie, a little bit mixed after the session that we saw in Asia.
Yeah, struggling for a bit of direction. Of course, we're waiting for what's going to happen with the Fed. Treasuries holding on to gains. Gold sliding towards $19.50 an ounce. The Fed, Matt, when they announced their latest policy decision this afternoon, the markets are going to be keen focus on that. It's already extended 7 of those 9 emergency lending programs by 3 months to December 31st. Joining us now to discuss all this is Paul Markham, Newton Investment Management Global Equities Portfolio Manager. Paul, let's start with the Fed. Is the Fed injecting a bit of fear into the U.S. and global risk this morning?
Well, it does feel as if they feel the need to make an announcement and to reassure markets that they are prolonging the programs which they've already put in place. There had been an expectation, not least from us, that there really wouldn't be too much in the news this week, despite there being an FOMC meeting. But clearly there has been some concern. You know, the dollar's been weakening off very significantly. There are some renewed concerns around the coronavirus spreading. So it feels as if there's some kind of sense of underwriting markets to some extent.
What do you expect the Fed to do? What do you think the Fed should be doing here, Paul?
Well, it feels to us that the colossal amount of stimulus which has come clearly monetarily from the Fed, but also, of course, from the government in the form of fiscal stimulus is very sufficient in many scenarios to help pull the economy through. I think at this stage the Fed will be loath to do too much more until it's firstly evident to them how effective their current measures are, and it takes a little while and the lag for that to come through, and also to wait and see a little bit around how the current, if you like, mini second wave, the kind of resurgence of the virus in some states comes through. So it feels like, given the fact we're in the middle of the summer, it's quiet, that they've already put a lot in place, that they'll probably stand pat this time around with any form of significant action. But if we don't see too much improvement before September's meeting, then I suspect we might see something a little bit more radical or aggressive at that stage.
Paul, do you think Jay Powell today can say anything at all without being too political to nudge forward these stimulus discussions taking place in D.C.?
That will certainly be on his mind. There's no doubt about that, because they do seem to have stalled, as you just mentioned. But I don't think he'll want to get too far into that. It's a very dangerous and strange time. Dangerous because historically the Fed has tried to recede into the background during a presidential election year, particularly the second half of the year, and also because we are in strange times and in a situation which we haven't experienced before. So I think that he will do as much as he can verbally within the bounds of what is acceptable from a market and economic perspective. I think he will, however, have to fight shy of saying anything which could be interpreted in any way as being politically oriented or biased.
You know, speaking of strange times, a lot of superlatives over the last couple of trading sessions. The one that I think is the most interesting and possibly the most concerning, depending on how you see it, is real rates on U.S. Treasuries have gone more negative than ever before. Even as we see, Paul, this incredible equity rally. I mean, the S&P 500 went from 2250 to now 3218. In that time, we've seen real rates, and I think we've got a chart on this as well. It's 2969. Real rates just continue to come down further and further. What does that mean? Why do we see that kind of fear? Investors stocking up on the safe haven bonds as stocks rise.
Well, I mean, historically, it's always been a kind of much quoted mantra that fixed income markets tend to get it right more often than equity investors. There's also, of course, the sort of half-joking joking quotation that the bond market has predicted 10 of the last 5 recessions, those kind of things. And from that point of view, there are two ways of looking at this. One of them is to say, well, certainly for the near term, the inflationary outlook is very muted. You could also make the point that structurally that we could see some very significant changes in the economy, and it could be permanently impaired. And let's not forget, of course, that earnings didn't grow at all in 2019, despite an S&P which went up nearly 30% in local currency US dollar terms, which was a significant re-rating for equities on expectation or hope, if you like, I guess, of increasing corporate earnings and a better economic outlook. Now, on the other side of that, of course, there is a very obvious technical here, which is that the kind of equities which have tended to lead the market in the last decade have been those which have performed in inverse correlation to treasury yields, and that tends to be the big tech names. And the big five, as we know, now make up 25% of market capitalization in the US. So again, there's some logic to that. What I guess I think we're seeing in the near term is that treasury markets are saying, well, the whole uncertainty of this outlook continues. The central bank, the Fed has your back as an investor. And just right now, it doesn't feel as if that potential for reflation, which usually comes around as a result of contemporaneous monetary and fiscal stimulus, doesn't feel like that's coming through. So we may.
Hello and good morning, everybody. Welcome to SG Trader, the live day trading channel. You can follow us for free, copy our trades, and make some profit. Just a few points. We're not an academy or trading college, and we do not teach you to trade. We trade live our own funds, so we don't have time to chit chat. If you would like to learn and make a day trading as your second job, you need to get our strategy. The website address you can find on our ticker address. What we show you today, we show you 5 pairs on the screen. We'll trade today for you Japanese yen, British pound, Canadian dollar, euro, and Bitcoin. Every time when we place trade, we will do it before the trade will be executed. And when we sell our position, again, we will place stop and profit and all of our followers will see when the trade will be executed.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacqua.
The national security bill was passed by Chinese lawmakers. The Hong Kong police force has already acted in accordance with the new law.
It's a very disturbing development.
This is, in effect, an attempt to end one country, two systems.
The central government is telling us just stay out of politics.
Last year, we took you inside the political turmoil gripping Hong Kong. This year, Beijing tightened its position with a new national security law. Will this jeopardize Hong Kong's position as a global financial center? And will China face the consequences from abroad? I'm Stephen Engel. We take a second look at the crisis facing the city in a Bloomberg television special, Hong Kong on Edge 2.
Welcome back to the European Open. We're just about 10 minutes into the market trading day this morning. FTSE 100 and the CAC 40 are both in the green, but the DAX a little bit under pressure this morning. Let's get the Bloomberg Business Flash. Here's Laura Wright. Laura?
Thanks, Anne-Marie. Deutsche Bank has reported the biggest gain in fixed income trading in almost 8 years. The market-boosting boss Christian Savings' turnaround efforts for a third straight quarter. Income from buying and selling debt securities rose 39% from a year earlier. It offset weaker revenue in asset and wealth management. Santander has booked a 12.6 billion euro hit from the coronavirus pandemic. It's the biggest blow yet to a European banking industry struggling to contain the fallout. The lender expects lower cash flows at its units in the UK, US, Poland, and at its consumer finance business. Santander also expects costs to keep rising this year. Credit Suisse is set to announce a sweeping overhaul of its business. Sources tell Bloomberg the Swiss lender plans to merge its investment bank and capital markets unit. The changes are part of an overhaul by Chief Executive Thomas Gottstein. They may be announced when the bank posts second quarter results tomorrow. That's your Bloomberg Business Flash. Anne-Marie, Nat.
Laura, thanks very much. Laura right there with your Bloomberg Business Flash. Now, Barclays traders had a blockbuster second quarter, offsetting the British retail turmoil caused by the pandemic. The bank's securities division reported a 60% gain in foreign exchange rates and credit trading revenue. But the lender also took a £1.6 billion charge to anticipate bad loans from the crisis. That was higher than had been expected, bringing the total to $3.7 billion so far this year. Here's what the CEO, Jess Staley, had to say about that.
Clearly, there's been an extraordinary economic contraction globally, but particularly in the U.S. and in the UK, our two principal markets. We've taken a sizable impairment reserve, £3.6 billion for the first half, including the £1.6 billion in the second quarter. The vast majority of that are derived by our risk models, where we put economic forecasts into those models, future unemployment rates, future GDP rates, spend growth, etc. And those models produce those impairment numbers. And we think we have been conservative to build proper impairment reserves. Let's see how the economies, particularly in the UK and the US, unfold in the next couple of quarters. But we like the comfort of having strong impairment numbers, but yet at the same time maintaining profitability for the bank.
Jess, good morning. I'm looking at your investment banking business. Absolute massive beats really across the board. Fixed income up 60%. The estimate was 30%. Equities trading up 30%. Estimate was 3%. The question is, could Barclays keep this up?
You know, we've had, I think, very good performance in our markets business over the last couple of years, and clearly in the last couple of quarters. I think, like all the banks that have reported thus far have commented on, the volatility in the first two quarters were quite exceptional this year. And I think people are expecting a degree of normalization. But as you mentioned, with our fixed income, credit, and currency trading up 60% for the second quarter, then up 80% for the first half year overall, I think we're gaining market share. We want to stay open and available for our buy-side clients, the insurance companies, pension funds, et cetera, that underscore the capital markets. But I'd also say that I think what we're seeing is in part the result of a lot of regulatory changes over the last decade. If you go back to the crisis of 2008, 2009, it was really based on bank balance sheets getting into trouble. What I think governments have properly done is they've really moved the focus of financing economic growth from banks to the capital markets, to companies issuing debt and equity, and to firms like pension funds and mutual funds buying those securities. That's really the story, I think, of the first and second quarter, is the resurgence of the capital markets led by massive amounts of liquidity provided by central banks. And I think that has proved to be a fairly constructive response to the pandemic and the consequential economic crisis.
I wanted to ask you about the dividend. I know the report says you'll have discussions about it towards the end of the year, but are you talking to the regulator about bringing the dividend back?
I think what we have all settled on, and I think the decision around the dividend earlier on in this year, given the enormous economic uncertainty we all faced, is understandable. We don't know what the second half is ultimately going to mean for the economies and for the bank itself. I think the current program to move out to the fourth quarter of 2020, discussions about dividend payments in 2021 is prudent. And so we'll have those discussions with our board, first and foremost, but then also with our regulators. So I think we're going to leave it to towards the end of the year to try to make a determination as to reinstating our dividends next year or not.
That was Jess Staley, the CEO of Barclays, speaking to Matt and I a little bit earlier this hour. Now, Paul Markham, Newton Investment Management Global Equities Portfolio Manager, is still with us. Paul, what do you make of all the bank earnings? I mean, Wall Street, this is one of the best quarters in modern history. You saw Jess Staley there talking about their investment banking business. What happens? Does this all kind of go downhill from here, given the volatility we had the first half of the year?
Well, there's been an interesting transfer of economic value within the universal banks from the IB, the investment bank part of the business, being seen by investors as something of a liability, and the retail and commercial bank perhaps being a steadier business, to there being a bit of a flip around, and actually ROE generation coming through on a much more even basis in the last couple of quarters, with the IBs contributing much more. And that's something which Jess just mentioned, and I think he's absolutely right. Whether or not that can be sustained is another question, really, because to some extent we have seen repositioning by investors, which has led to much higher trading volumes in cash securities, for example. I do think that also the IBs have had a benefit in extending facilities, maybe market access and so on, to some corporates, particularly on the debt side. So that's something which has been very positive for them as well. As we go forward, there will continue to be concerns, clearly, on the individual and corporate banking side of things, particularly as asset quality is likely to fall. And also, of course, demand for new loans and new funding has come around really in a kind of stressed environment, in an emergency situation, not really businesses getting onto the front foot and investing, which is ideally the way that you want to lend as a bank. So that side of the business will continue, I think, to be under pressure.
Paul, what do you think I'm looking at a euro that's going for $1.17 still. What does that do to European bank earnings? And also, how much further do you expect the dollar to fall?
Well, I think to take your second question first, Matt, the dollar has already come down very significantly and at all-time lows now against some currencies. It does feel as if maybe it's due a pause. There's certainly the different feel to this weaker dollar, which is much more fundamentally driven rather than a risk-on weakness in the US dollar, which is a little bit of a different thing to what we've seen in recent years. From the point of view of Euro banks, clearly a lot of them do have a lot of overseas earnings, and that is going to be a headwind for them. It could be hoped that if there is a consequent revival in European economic activity and a feeling of a bit of a stronger European domestic economy, the banks could actually be quite strong beneficiaries of that in some cases. But let's not forget that since the crisis, many of those banks have been very keen to diversify away from their domestic revenue bases to overseas style, and particularly, actually, in many cases, where they can, in the US. So I think that's something which could potentially be quite different for different banks. The smaller ones will probably find a stronger euro quite beneficial. The larger ones probably less so.
Paul, Goldman is warning about the king dollar as the world's reserve currency. Are you worried about dollar debasement?
Well, we have this sort of debate come up every now and again, and so far there hasn't really been a truly viable alternative. The euro has never really fulfilled that role in the sense that there's never been quite enough clarity around the sense of purpose of the European institutions. From the point of view of the RMB, for example, again, that would need to be a much more market-oriented and market-friendly currency, and also monetary policy in order for that to succeed as well. So it feels that the dollar can continue to be a linchpin for the global economy for a period of time, even if it's a little bit by default in a period where it is becoming a little bit weaker. There is, of course, a chance that once the interest rate differential, which it enjoyed relative to other developing economies, is wiped out for a period of time, a longer period of time than it has been, then you get a bit of a structural weaker outlook for it. So I think there could be a little bit, but I feel that over time the dollar will probably survive and probably thrive.
Survive and thrive. Thank you so much, Paul Markham, Newton Investment Management, Global Equities Portfolio Manager, for joining us. And Paul will be continuing the conversation with Matt on Bloomberg Radio at 9 a.m. UK time. Now, coming up, it's the antitrust showdown. The CEOs of the tech's Big Four are set to be grilled by Congress today. We'll discuss what to expect from their testimonies next. We got a bit of a sneak peek of that last night. This is Bloomberg.
It's not exactly what we would have wanted, but we're trying to, as much as we can, take precautions in order to make sure that we stay safe and that we're not, endangering anybody here. We want to make sure that we've got COVID tests before we left the state of Florida. I'm honestly happy to be out of the state of Florida because I feel like Florida is just starting to spike and it's becoming its epicenter, which is definitely somewhere where I don't want to be. So I'm happy that we got the test, we cleared negative, and then we were just out of there.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. Keep on, so you can keep on.
Welcome back to Bloomberg Markets. This is the European Open. We are 23 minutes into the trading day, looking at a gain in Paris of 0.4%. In London and in Frankfurt, we see drops of 1 to 0.2%. So struggling for a little bit of direction here as U.S. futures rise. Today, all eyes will be on the CEOs from 4 of the biggest U.S. tech companies as they testify before Congress in Washington. Apple, Amazon, Facebook, and Alphabet are set for an antitrust showdown with a House panel investigating competition issues in the industry. For more, we're joined by Alex Webb, Bloomberg Opinion tech columnist. So, Alex, what are the key questions that are facing these CEOs in Congress today?
Well, I mean, short of breaking them down individually, you know, each company has individual issues. Apple is about its control of the App Store. Google, probably to do with digital advertising. Facebook, similar, but also how many different platforms it controls. Amazon, its control of marketplace, whether it can then introduce competing goods. Yeah, that's all 4. So, you know, it's quite disparate for all of them, and it'll be difficult, I think, to get concrete answers given the disparate nature of the challenge.
Also, it's going to be very interesting for Jeff Bezos. This is his first time being grilled by Congress. I want to ask you, Alex, as well, what can we expect from the tech world in terms of earnings coming up this week?
I mean, really to see how they've been affected by the virus. You know, in the case of Amazon, probably something positive, and that might not help its case when it comes to antitrust, of course, because if they are gone from sort of becoming the everything store to the only store, then it suggests they have a more dominant position they did beforehand. But Google and Facebook, let's not forget, these are advertising companies. And the first things that companies cut when there's a downturn is their marketing spend. So it looks like they might not be quite as rosy. Of course, people aren't going to shops and buying iPhones either. So Apple, although one should say Apple is expecting that demand that might have suffered in the short term to resurface later in the year or perhaps next year when people are allowed out again.
All right, Alex, thanks very much. Alex Webb there giving us his take, well, a preview, I guess, of what to expect today. Definitely type OPIN GO on your Bloomberg terminal tomorrow to get Alex's take on this and to get the work of his colleagues. I think it's one of my favorite landing pages on the Bloomberg terminal. Up next, we're going to talk about discount airliner Wizz Air. It reports quarterly revenue beating estimates as it adds new routes, and we'll get all the details from the biggest expert there is on Wizz Air, the Chief Executive Officer. Joseph Arati joins us next. This is Bloomberg.
Quand on voit la mort de George Floyd, on image la mort de mon petit frère Adama Traoré. Et la France va dénoncer tout de suite ce qui va se passer aux États-Unis. Nous, dans le combat vérité-justice pour Adama, vraiment dans le court terme, ce qu'on attend et ce qu'on exige surtout, c'est la mise en examen des gendarmes, la condamnation des gendarmes et d'un procès public. Aujourd'hui, on dénonce le déni de justice qui est en France depuis 4 ans. des soldats malgré nous. Hein. Face à nous, c'est une machine de guerre qui n'a ni sentiment, ni état d'âme, ni remords. C'est le mouvement du comité Adama, de la nouvelle génération Adama. Aujourd'hui, moi je suis là, nous sommes là, on changera peut-être pas le monde du jour au lendemain, mais on changera des choses.
Fees that retail has had to pay to be able to enter the markets, the democratization of the markets by allowing them to have direct access to the markets over the last 10 to 20 years has really been, a key trend that has driven, I would say, the U.S. markets.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Open. We're 30 minutes into the trading day. I'm Anne-Marie Hordern here in the city of London. Matt Miller alongside me in Berlin. Let's take a look at the story, the equity story so far, what's going on the Stock 600, the benchmark index. We're down 0.2%. It's been a bit of a global mixed picture. Equity struggling for direction ahead of the Fed today. The FTSE and the DAX are lower, but the CAC 40 is up nearly 0.4% this morning. If we switch it up and look at what's going on in this sector picture this morning, retail is the shining star, up 1.2%. This comes as Kering is pushing higher. Their online sales jumped 72% today, so a bit of a sign of recovery. Also Next, the high street retailer here in the UK, they are more optimistic for a profitable year. Also, I want to bring your attention to the financials. They are up 0.2% today. We did hear from a number of banks. Deutsche Bank, big boost from the trading unit, and Barclays shares are lower, though. Citi said they expected more. Matt, good morning.
Good morning, Anne-Marie. Let's take a look at what's happening today, what you should be keeping your eye on here in Germany. The economy minister, Peter Altmaier, and the finance minister, Olaf Scholz, will be questioned by the Bundestag's Finance Committee about their roles in the Wirecard scandal. The special session, which interrupts the summer recess, will be held behind closed doors, so we'll have to wait to get commentary from others after the fact. We're going to get Brazil's unemployment figures for June at 1 p.m. London time today. That country, of course, has been very hard hit by the pandemic, and a rise in numbers could be a side effect of the gradual reopening of the economy. The bosses, as we've been telling you, of Amazon, Facebook, Alphabet, and Apple are due to testify before a U.S. antitrust panel as part of a government probe into digital competition, or the lack thereof. The CEOs are appearing together for the first time before lawmakers. That starts at 5 p.m. London time. And it's decision day for the Fed. The FOMC is expected to keep interest rates near zero and repeat its guidance that they'll stay that way until the economy shows it's back on track after this coronavirus, if there ever is an after. Let's get the Bloomberg First Word News now. For that, we go to Laura Wright in London. Laura?
Thanks, Matt. Stimulus talks in the US are getting bogged down over liability protections. Part of Senate Majority Leader Mitch McConnell's plan is to provide a shield from coronavirus lawsuits to schools and businesses. House Speaker Nancy Pelosi says his insistence on this part of the package remaining exactly as proposed shows he's not serious about reaching a deal. The Federal Reserve has extended most of its emergency lending programs by 3 months. The move comes ahead of its policy decision later today. With signs the recovery may be stalling, the Fed is likely to hold policy, but investors are on the lookout for any specific forward guidance on the path of rates. The UK is looking at ways to loosen its coronavirus quarantine rules. That's after restrictions on trips to Spain provoked a backlash from tourists, airlines, and the government in Madrid. One possibility is abandoning blanket restrictions in favour of regional bans. Another is reducing the time passengers arriving in Britain need to stay in quarantine. The UK and US have voiced new concern about Hong Kong's upcoming elections. That's after a flurry of local media reports the government is considering postponing the vote, maybe for a whole year. Hong Kong's opposition argues the coronavirus outbreak is being used as an excuse to put off the pivotal election. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg Anne-Marie. Matt.
Laura Wright in London, thank you so much. Now, Wizz Air is seeing an opportunity to expand. The discount airline reported revenue for the quarter that beat estimates. Now it's adding 200 new routes and redeploying 22 planes to different markets. It hopes to emerge as a, quote, structural winner from the current disruption. Joining us now is Joseph Varadi, Wizz Air CEO. Joseph, thanks so much for joining us today. I want to ask you first, how worried are you about the resurgence of cases? We already see the UK asking travelers that are coming from Spain to self-isolate for 14 days. These types of measures, how much could they impact your business that you've already started to see recoup?
No, thank you for inviting me. I mean, clearly we are seeing a kind of a changing situation. We used to believe that, we fell into a deep crisis, but there is a recovery path from it. And once you recover, you're going to be seeing some more stabilized set of circumstances. That's really not the case, because I think we should be expecting more of a roller coaster effect. Things could improve and can deteriorate quite quickly, and it depends on the markets we are talking about. Spain is a good example. Spain did very well in terms of controlling the pandemic matters in the country. Now the numbers are going into the wrong direction, and some actions are taken by other countries like the UK to restrict travel, and we should be expecting more and more of this. Having said all of that, I think overall the situation is improving. I think Europe is getting pandemic more controlled than before. We are also seeing some European coordination coming into play. It used to be down to the countries to take all sorts of decisions, and those were made in a non-coordinated fashion. I think that's improving, but certainly we are facing a period of uncertainty and volatility. So businesses will have to adjust, and will have to be micromanaged in a way. And you need to react to the changes pretty much day by day. This is what we are doing.
So Joseph, Matt Miller here in Berlin. You say that you expect to see more situations like we're seeing between the UK and Spain. I think Sweden also has a 10-day quarantine on people coming back from Spain. Does that mean you're going to be reducing flights because you've ramped up pretty quickly?
Yeah, that's correct. Last week we were operating 77% of our capacity of last year versus the industry's recovery of 40%. So we've done much better than the industry. But the issue is, as you say, the situation can change up or down. And I think this is what's required from businesses like ourselves and also from other airlines, that you need to take note of those changes, and you need to keep shifting capacity in accordance with demand. A few months ago, some countries were basically locked down. We couldn't operate. Now those countries are doing very well, the UK included, and some other countries who did very well a few months ago are now struggling because of the pandemic situation in the country. So the balance keeps shifting, and you as a business have to react to that, and you have to adjust capacity accordingly, up or down.
So your schedule is pretty robust, but what about the passenger levels? Your load factor in June was about 53%. Without an improvement in passenger levels, can you still turn a profit on the year?
Yeah, so our load factor continues to improve. We are tracking around 65–70% as we speak. Now you have to take note of the fact that this industry is now managed for cash, and the cash break-even point measured on load factor is different from the overall profit break-even point. So we are contributing to cash. So we are a cash neutral, slightly cash positive operation as we speak, and that is very important, because you have to manage this business for liquidity. You clearly see that all the uncertainties and issues surrounding the industry drag liquidity, drag cash quite significantly, but we are managing the business for that. We have a very strong liquidity position. Even if we don't operate a single flight in the next 2 years, we are still in business, but we are very focused to preserve as much cash as we can.
If we continue to deal with, corridors being closed and the quarantines being reenacted, aren't you going to want to, if not cancel some of your order with Airbus, at least defer it? I mean, why would you take on so many planes if you have to continue to worry about load factors and getting to capacity?
We took a strategic decision to continue to take new aircraft deliveries. New aircraft is a source of competitive advantage. as a result of operating new aircraft, we are able to lower our unit cost versus our competitors who rely on old aircraft, and their unit cost is going to creep. We are in a commodity business, and in commodities, lowest cost prevails, and this is what we are thriving. So I think that's a very important issue to us. But also, we see this pandemic situation not only a short-term pain, but also an opportunity for a long-term gain. We're seeing that being the lowest cost producer in the industry makes us a structural winner. So we are actually looking for growth opportunities. That is the reason why we are reallocating some of our capacity from existing markets to new markets to take advantage of the market consolidation, which is happening.
Joseph, thanks so much for joining us this morning. Joseph Varadi, the Wizz Air CEO, on their earnings day. Now up next, diversity and credit worthiness. Moody's called Lloyds Bank race action plan credit positive. This is the first time Moody's is giving this kind of rating to this program. We're going to speak to the author of that report. That's coming up next. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open, 42 minutes into the trading day, and we've now seen markets turn higher. So equity indexes that were down outside of Paris have turned back to gains, and the gains that we saw on the CAC 40 have now increased to 0.9%. So it's looking more risk on as U.S. futures rise. Let's get the Bloomberg Business Flash right now. For that, we go to Laura Wright in London. Laura?
Thanks, Matt. Gucci owner Kering is seeing signs of a recovery after a sales plunge. Online orders jumped 72% in the second quarter, but they still only account for a small proportion of overall sales, which were down 44%. That's a bigger drop than rival LVMH, but less than expected. The firm says it's weathered what it hopes is the worst of the crisis. eBay has raised its profit and sales forecast for the year, but the new outlook disappointed investors. They'd hoped the digital marketplace would take a greater advantage of the surge in online spending during the pandemic, and there are concerns that when lockdowns are lifted, the company could return to sluggish growth. Credit Suisse is set to announce a sweeping overhaul of its business. Sources tell Bloomberg the Swiss lender plans to merge its investment bank and capital markets unit. The changes are part of an overhaul by Chief Executive Thomas Gottstein. They may be announced when the bank posts second quarter results tomorrow. That's your Bloomberg Business Flash. Matt, Anne-Marie.
All right, thank you so much for that. Let's turn to diversity and creditworthiness this morning. Investors rely on agencies such as Moody's to provide data and analysis on a company's creditworthiness, and ESG risk are increasingly becoming part of those calculations. Now, for the first time, a rating agency has explicitly linked a firm's stability to its ethnic diversity plans. Moody's has called Lloyds Bank's Race Action Plan, which aims to boost diversity and increase the number of black employees to senior positions, a credit-positive step. Now, we also asked Jess Staley, Barclays CEO, on the steps their bank is taking on diversity. Take a listen.
We have to take a special look at race. The challenge of our black professionals around the world is something that we need to be keenly focused on. We need to move away from statements and get into constructive measures going forward, and that's what we're committed and dedicated to do. And we've made a number of organizational changes and set out a number of programs to really move the race issue forward at Barclays.
Joining us now to talk about diversity and creditworthiness for banks is Eduardo Calandro, Moody's Investor Services Senior Analyst. Eduardo, thanks so much for joining us this morning. This is the first time Moody's is giving this kind of rating to a program like this. Will you start to rate more firms based on diversity? Isn't this the only way to really start to affect change?
Thank you. Well, just to be precise, we didn't assign a specific diversity rating to Lloyds, nor we changed the rating to Lloyds, but we provide our comment on a recent announcement Lloyds made. And in the comment, Lloyds committed to increase the representation of black staff among senior management, amongst other measures. The percentage to 3% by 2025, and we believe that that was credit positive. And we think that it is credit positive because it responds to a direct demand from investors, politicians, and regulators for banks to be more socially active part, having a more social active role, and so increased diversity is therefore positive. Just to quote some numbers, this was not the first time that Lloyds had similar programs. In 2018, it set a target for 2020 for ethnic minorities in general, so their target was 10% of the overall staff and 8% of senior management being made of ethnic minorities, and they're very close to those targets. Now, 7.3% of senior management at Lloyds is of an ethnic minority background. What Lloyds discovered is that within ethnic minorities, blacks remain underrepresented, and at the moment, 1.5% of the population of the staff at the organization is black, and 0.7% of senior management. So they had some specific targets of 3% by 2025, which is broadly in line with the black population in the Great Britain.
Eduardo, look, you know, here in Germany, of course, it's not, I don't think it's legal even to ask the race and tally the data on different racial makeups of companies. Do you get that data from a lot of companies outside of Germany? Do you get a lot of that actual racial data from all the British companies that you need?
No. We are just at the beginning of that, and it's a voluntary disclosure. Barclays, for example, has been publishing an ethnicity gap report in terms of pay and composition of the staff for the past couple of years. But it's something that is getting increased interest from investors, and banks are complying to that. Actually, the Bank of England, which is the main regulator of UK banks, has some targets itself. So in 2014, he set some targets for 2020. They actually increased those targets in the meantime. And they have specific targets of 20% of the entire staff being ethnic minority. In 2019, there were 19, and 13% of senior management being of an ethnic minority by 2022. They're a little bit behind there, they're just 5%.
So, Eduardo, should all rating agencies be doing this? And can you tell us about some other banks you may end up giving a credit positive or credit negative based on their diversity plans?
So this diversity plan is especially targeted at blacks. This is something relatively recent. So Lloyd started last week. HSBC just 3 days ago had an internal memo that the bank itself confirmed to the press that they are targeting to double the amount of black staff by 2025. But we don't know the starting point at the moment. But we expect, as we have more data, to be able to analyze it better, which actually diversity and inclusion is part of our consideration when we assess ESG risk environment, in this case the S part, the social part.
Of course. Thank you, Eduardo Calandro, Moody's Investor Services Senior Analyst, for joining us this morning, talking about diversity that all the banks are looking at changing internally. Now, coming up, which assets will suffer without Fed help? We'll put that question, it's our MLive question of the day, to Bloomberg's Simon Flint. Next, this is Bloomberg.
Welcome back to the European Open. We are 52 minutes into the session right now, and we are seeing green arrows across the board. The biggest gainer here, the CAC 40 in Paris, up almost 1%, doing far better than the rest of the benchmark indexes. The FTSE, for example, only up 0.4%. That's as Kering posts a big 5.5% gain and helps to lift the index together with Capgemini and Schneider. Joining us now is Simon Flint. He's Bloomberg's emerging markets strategist. And today we're asking the MLive question of the day: which assets will suffer without Fed help? We're going to get the FOMC decision later. Simon, what do you expect?
Well, the answer to your question is without the Fed's help, absolutely everything suffers. But I guess the pain would be focused in the lowest quality assets in emerging markets, the highest yielding, those with the poorest current account profile. So you're talking about Latin America, South Africa, and in the region, in Asia, perhaps the Indonesian rupiah.
Simon, I have a question for you about what's going on in the gold market. We have the real yield on the 10-year Treasury closing below its previous record low. This is obviously going to be a huge gain for gold, but we're seeing this big divergence in terms of what analysts think for gold. Bank of America is saying as high as 3,000, while JP Morgan says it might be the last hurrah for gold. Where do you see it going?
Well, it's consolidation time, according to Eddie von der Walt, who's our expert in London. I think if you look at the last few days, few weeks, gold's really gone pretty crazy. Yesterday, the RSI on a 14-day basis reached a level that we've only seen 5 times in the last 20 years. So in that respect, it looks quite vulnerable.
What do you think about the ever-falling dollar? How is that going to affect the emerging markets that you cover?
I mean, it should be pretty beneficial, right? So we're in an era where the dollar's kind of soft. You've got super low real interest rates. And at least so far, we haven't seen investors returning in significant size to either emerging market bond markets or EM stock markets either. So there is still some scope for flow into those emerging markets, provided, as you said at the top, that the Fed doesn't take everything away from us.
Thanks to Simon Flint. He's Bloomberg's emerging market strategist. Catch all of his commentary over at MLive. And stay with Bloomberg TV today. Full coverage of today's Fed decision. We have a special report that's at 7 p.m. London time. Matt, European markets doing a little bit of a turnaround this morning. The CAC up nearly 1%. FTSE 100 up nearly 0.4%. And the DAX, where you sit, also eking out a bit of a gain.
Yeah, we are seeing some gains. Really, Schneider Electric is boosting the CAC today, but Kering and L'Oreal, LVMH, also all doing quite well and helping to lift the French benchmark. You can see the FTSE MIB is down a little bit, but most European equity indexes are gaining, and U.S. futures are gaining as well. Now putting up some pretty strong gains. NASDAQ, big tech companies up 0.5%. Futures are up 0.5% as we wait for the FANG CEOs to speak in front of Congress. That's it for the European Open. Bloomberg Surveillance is up next.
Fed prolongs 7 of its 9 emergency programs until year-end in its latest effort to support the economy. In Washington, stimulus talks stall. Trading boost to Deutsche Bank posts a small profit after its best FIC performance in almost 8 years. The CFO tells us the lender is working towards breaking even this year. And profit at Barclays plunges. The British bank warns of a challenging second half of 2020. We'll hear from the chief executive, Jess Staley. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacroix here in London. Now, the markets are moving on a couple of things. First, they're still looking at numbers of infected across the world, but they're also mixed before the Fed decision. So I'm looking at stocks that, frankly, are struggling for a bit of direction in most markets. Treasury is pretty much steady. It's all about the Fed, the policy meeting, and what exactly they will give us in terms of indications. Now, in Asia, stocks did see modest gains in Hong Kong and South Korea. They outperformed in China, but there were very low volumes. Gold at 1,957. It's a really good test. I've been looking at gold and Bitcoin, actually, much more than I have over the last 24 months. Now let's get straight to the Bloomberg First Word News. Here in London is Laura Wright. Hi, Laura.
Thanks, Francine. The UK is looking at ways to loosen its coronavirus quarantine rules. That's after restrictions on trips to Spain provoked a backlash from tourists, airlines, and the government in Madrid. One possibility is abandoning blanket restrictions in favour of regional bans. Another is reducing the time passengers arriving in Britain need to stay in quarantine. The UK and US have voiced new concern about Hong Kong's upcoming elections. That's after a flurry of local media reports the government is considering postponing the vote, maybe for a whole year. Hong Kong's opposition argues the coronavirus outbreak is being used as an excuse to put off the pivotal election. US Attorney General William Barr has defended himself against accusations he's politicized his position to help President Donald Trump. In opening remarks to the House Judiciary Committee, he said the president has not attempted to interfere. In fact, he says the president told him to make whatever call he thinks is right. Some of the biggest names in the tech industry are set to testify in the US House today. It's part of a government probe into digital competition. For Amazon boss Jeff Bezos, it will be his first appearance before Congress. According to a pre-release testimony, he'll strike an upbeat tone, telling lawmakers his company is an American success story. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Thank you so much, Laura. Now, the Fed extended 7 of its 9 emergency lending programs by 3 months to December 31st in its latest effort to boost the economy. Now, the move comes ahead of the FOMC decision today that's widely expected to result in no significant policy changes. Meanwhile, stimulus talks between President Donald Trump's team and Democrats have stalled, while Senate Majority Leader Mitch McConnell insisted his plan for shielding organization against lawsuits stemming from coronavirus cases should be included in the bill. House Speaker Nancy Pelosi said McConnell's stance suggests he's not serious about reaching a deal. Well, joining us this morning is Sophie Wynne, multi-asset strategist at Societe Generale. Sophie, thank you so much for joining us. When you look at what the markets are doing today, good morning, they seem to be moving sideways. But actually, over the last month, they focus a bit on the stimulus, they focus a bit on central banks. What do you think is driving, assets and equities right now?
What you've seen since mid-June is basically the cyclical rotation that has been stopped short because of the worries on the second wave. I think what's driving markets recently is worries on whether the second wave will translate into another week of lockdown. And that's going to be significant to monitor in the Q3 earnings season rather than this one. But more importantly, ahead of U.S. elections, it's going to be important to know what kind of fiscal package will be pushed by President Trump as well as Joe Biden in their campaign proposal.
Sophie, where do you see the best value right now? It does look like, companies and industries are doing well, are also very, very expensive.
I guess that it really depends on the macro scenario you have. Investors are talking a lot about bubble at this point, at a time where in terms of equity positioning, it's not stretched. And we've seen more outflows from equities rather than inflows since the start of the year. Having said that, if you have an L-shaped scenario, then investors will continue to buy growth and the tech and their bond proxy. So even if they're expensive, you should rather buy this because they will perform well, whichever the scenario. If you're more in a swoosh scenario, then, you know, the big question for me in the second half of the year is really value versus growth.
Sophie, does anything feel like it's in bubble territory right now? Is there anything that looks risky?
What we're looking into at the moment is whether we have another tech bubble. Something to keep in mind, though, is that when you look at the EBIT margins of the tech companies, it's way higher versus the rest of the U.S. equity market. So it's something to take into account, even if, as you were mentioning, I mean, there's all this antitrust, digital taxation, but also this social media scrutiny that could potentially weigh on the tech sector. So, you know, if you have a swoosh recovery and this regulatory issue going on, then it could constitute a trigger for the underperformance of NASDAQ versus mid-caps in this context.
A lot of the focus today, Sophie, will be on a lot of the technology stocks and the FANG stocks because of hearings. What is the biggest risk for FANG stocks right now, or in general technology stocks? That they're expensive, or the regulation aspect?
I think it's more, as a trigger, it's going to be more a regulatory aspect. You have several things going on, as I was mentioning, digital tax, which is not only US but broader OECD, so this is still ongoing. The regulatory side, it's much more on the antitrust at the time where, you know, the top 15 companies of the S&P represent 16% of US GDP. It's unprecedented, and it's really showing that there is an issue going on. So I think the regulatory side of things is more a trigger rather than how expensive they are. Because how expensive they are, it's more in the macroeconomic context you need to take into account. And you'll be ready to continue buying expensive things if you're uneasy about the economic scenario.
Sophia, what is the economic scenario that we should, you know, be looking at right now? It seems that there's a resurgence in cases maybe sooner than many people thought. Are we going to be in this on-off, you know, if it's not lockdown but quarantine phase? And what does that mean for asset valuations?
For me, the question is either this will translate into another wave of lockdown. It's not our scenario. Our baseline scenario for now remains a swoosh recovery with some recovery in the second half of the year. For now, it's rather on track if you look at the both soft and hard data. If you have some social distancing put in place and the fact that it's not going to translate into a generalized lockdown, then, you know, it feels like the global economy recovery path will be kind of protected, even if it's not going to be a V-shape. But in that context, you know, having some gold in a portfolio still makes sense because it's going to protect you either in a deflation scenario or in a reflation scenario.
Sophie, thank you so much. We'll get back to Sophie Winder, multi-asset strategist at Société Générale, very shortly in the next week or so. Now let's get back to earnings, and Deutsche Bank has reported the biggest gain in fixed income trading in almost 8 years. We've been speaking to the company's chief financial officer.
We're pleased with the performance in our investment bank overall, which is up about 52% ex items, and the FIC business is up 46% ex items. Within that, we have trading businesses, which are rates, FX, emerging markets, which, as you've seen with our peers, you know, are up significantly year over year. In our case, a little over 75%. And in the rates complex, we've now doubled our performance year over year for 3 straight quarters. So very pleased with that performance. Of course, part of it is participating in the better market opportunities that have existed in the second quarter, and we do expect a normalization of that. But you need to remember as well that in our case, we've been working to stabilize, grow the franchise, recover some market share. And so what we're pleased to see is that underneath that sort of outperformance in the market environment that we've been in, we've seen really good franchise stabilization, traction, client engagement, and improvement in client flows. And so we do think that that bodes well for the future.
As I said, you are expecting slightly higher revenue for the full year. Is is that not too conservative now, given what we've seen in the first half?
Well, it would be a normalization relative to the first half, but I think an improvement on last year's second half. Again, especially in our businesses, where a year ago we were going through a restructuring and there was some uncertainty around sort of our people and franchise. And so with that now behind us, we do see momentum in the core business, and we'd like to see a second half performance, well ahead of the last year's second half, but we'll see how the conditions evolve. As we all know, we are in a period of real uncertainty, and so while that's led to revenue opportunities, it can also lead to more muted markets.
You are currently looking at Wirecard to see if there are any parts that are worth acquiring. So far, what you've seen, do you like what you've seen so far?
Look, I'll speak generally about the payments business. I don't want to comment on specific events in the marketplace, but payments is a big business for us across a number of our segments, and of course the corporate bank in particular is a very large payments provider globally. We are and have been investing in our merchant services capabilities, and we'll continue to pursue that. As we see opportunities in the marketplace, we may well look to accelerate that growth inorganically, but it would have to fit well with what we do. It would have to be additive to shareholders, and we like how we're executing on that business also organically. The other thing is we're able to do a lot in partnerships. So you may have seen a few days ago we announced an investment in a company, TraxPay, which we're very pleased about. It does supply chain financing capabilities, and so adds to what we can do for our clients, sometimes in partnership. So we're pleased with the opportunities as well as the prospects to grow our business.
So would Wirecard Bank fit the pattern that you just described?
Well, it's hard to tell. I mean, certainly, again, merchant services is a business that they were in, and is one where we feel there's room for us to grow. But I don't want to kind of comment on any specific developments.
That was the Deutsche Bank Chief Financial Officer, James von Moltke. Now, stay with Bloomberg TV for full coverage of today's Fed decision. Don't miss our special report. That's at 7 p.m. London time, and this is Bloomberg.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Well, Weir Group has reported first half adjusted operating profit ahead of expectations. And the UK-based firm provides engineering solutions for the minerals, oil and gas, power and industrial markets. But the company also says that continued uncertainty means forward guidance remains withdrawn. Well, I'm delighted to be joined by John Stanton. He's the Chief Executive Officer of Weir Group. John, great to have you on the program. I know there's really uncertain times. If you look at, your oil unit, where do you see the bottom for that, given the oil oversupply that we're seeing at the moment?
Well, good morning, Francine. Thanks for having me. Yeah, our oil and gas business has clearly had a difficult first half of the year. Really focused as we are on North American shale, which has been seeing extremely difficult market conditions. And frankly, we think it probably is on the bottom at the moment and is likely to continue to be challenging over the balance of this year. As we announced in February, though, we are intending to exit this business at the right moment, and our long-term strategy is to become a mining technology pure play, which is essentially already 80% of revenues and where we see, a bright future in terms of our ongoing growth prospects.
So can you tell us, the unit was placed under review. Can you give us a bit more on the timeline, or actually, what your options would be for the oil unit?
Yeah, well, our intent is to exit at the right time when we can get the best value for the business. So we've been active over the last few months talking to industry participants to understand the level of interest, and of course preparing the business so that when we do identify a good buyer for the business, that we're ready to move quickly to do that. But clearly the market backdrop is somewhat challenging in terms of those conditions at the moment in North American shale principally. So we would like to be able to move quickly, but that depends on how our discussions develop with potential buyers from here. So it's not impossible that we'll sell it in the short term, but it may take a bit longer.
John, talk to me a little bit about minerals. So the unit was pretty resilient in the first half. What were the commodities that drove that result specifically?
So our mining businesses, both minerals and ESCO, are involved in the extraction and production of minerals, with the principal ones being copper, gold, and iron ore. And actually, production of those minerals has been, relatively robust in the round over the course of the last few months. So, we've really benefited from the fact that mining has been designated as an essential industry. In most countries, mines have been allowed to continue producing, notwithstanding other COVID-19 restrictions. We have been an essential supplier to that industry. That's why our revenues have been incredibly resilient, only down slightly on what was actually a record year last year with very strong top line. And our margins have been consistent as well, both in minerals and actually stronger in the ESCO division. So notwithstanding all of the challenges of the last few months, the profits that we've generated from our mining equipment businesses have been roughly flat year on year. So I think that's an incredible performance in the circumstances when you look at how many economies and industries have been impacted. And goes to the strength of our go-forward strategy, which is really around focusing on these businesses in the future.
John, a lot of your mining business also relates to services. I mean, can you give us any context or just walk us through how you think, customer access difficulties have been impacted by COVID-19?
Yeah, I mean, the vast majority of what we do, Francine, is to provide spares and aftermarket services. Between minerals and ESCO, our two mining divisions, it's roughly about 80% of the revenues. And so that means that as long as mines are continuing to produce copper or gold, then they're going to need the spare parts and services from Weir to enable them to keep producing. So the fact that most mines have kept going, they've kept producing the ore concentrates, means that the demand has been very strong for our equipment. we've had to do a lot to configure our plants and service centers around the world to ensure that we can keep going and make sure that we look after our people, have the right PPE, and reconfigure our operations so that we can maintain hygiene and social distancing. So, a lot of people talk about working from home. We've had 5,000 office-based workers doing that, but we've got 8,500 people in foundries and plants around the world who continue to go into work, with those new ways of working to ensure that we could continue to support our customers. So, and that's, the beauty of our business model is that, we are incredibly resilient, and as long as our customers are keeping producing, which they tend to do through the cycle, then we have to be there to support them, to keep them going with our mission-critical products. And that's really underpinned the resilience in the first half of the year.
All right, John, thank you so much. John Stanton there, the Chief Executive of Weir Group. We'll get back to John, and we also need to spend a bit of time talking about diversity. Now, coming up, we hear more from top European banking executives, including Jess Staley, the Chief Executive of Barclays. That's coming up. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacroix here in London. Now let's take a look at what's happening today. German Economy Minister Peter Altmaier and the Finance Minister Olaf Scholz will be questioned by the Bundestag about their role in the Wirecard scandal. The special session, which interrupts a summer recess, will be held behind closed doors. We'll also get Brazil's unemployment figures for June at 1 p.m. London time. The country's been hit hard by the pandemic. Later, the bosses of Amazon, Facebook, Alphabet, and Apple are due to testify before a U.S. antitrust panel as part of a government probe into digital competition. Then the chief executives are appearing together for the first time before lawmakers, and of course, it's decision day. So decision day for the Fed. The FOMC is expected to keep interest rates near zero and repeat its guidance that they'll stay that way until the economy is back on track. So we'll have plenty more, of course, on the Fed. We'll have plenty more, of course, on the markets. Also coming up, an impressive beat for drink makers Campari. We'll talk earnings with the company's chief executive, Bob Konsovitz. Apparently, we've been all drinking at home more, so one of the questions will be about wholesalers and when he expects a bit more of a back-to-normal drinking habit. So that's coming up shortly. I'm looking forward to that conversation. This is Bloomberg.
Another day of risk off across the financial markets. We bring special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacroix here in London. Now let's get straight to the Bloomberg First Word News. Here's Laura Wright. Hi, Laura.
Thanks, Francine. Stimulus talks in the US are getting bogged down over liability protections. Part of Senate Majority Leader Mitch McConnell's plan is to provide a shield from coronavirus lawsuits to schools and businesses. House Speaker Nancy Pelosi says his insistence on this part of the package remaining exactly as proposed shows he's not serious about reaching a deal. The Federal Reserve has extended most of its emergency lending programs by 3 months. The move comes ahead of its policy decision later today. With signs the recovery may be stalling, the Fed is likely to hold policy, but investors are on the lookout for any specific forward guidance on the path of rates. The UK is looking at ways to loosen its coronavirus quarantine rules. That's as restrictions on trips to Spain provoked a backlash from tourists, airlines, and the government in Madrid. One possibility is abandoning blanket restrictions in favour of regional bans. Another is reducing the time passengers arriving in Britain need to stay in quarantine. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Thank you so much, Laura. Now, Campari has reported first-half sales more than 4% above estimates. The Italian company behind Aperol, Wild Turkey Whiskey, and Sky Vodka reported an 11% drop in organic revenue. That's as increasing home sales failed to make up for a slump in orders from bars and restaurants during lockdown. Well, joining us now to discuss all of this is Bob Kunze-Koncewitz. He's the chief executive of Campari Group. Bob, as always, thank you so much for giving us a little bit of your very busy schedule. When you look at the Aperol revenue, how much is that actually linked to tourism?
Well, tourism was important for us in the past to actually recruit new consumers for the franchise. Obviously, Italy is quite a tourist destination, and we've also put, emphasis on the various hotspots in the Mediterranean. So clearly, that's not. I don't think we're going to get that this year. Having said that, we've pivoted quite well from a marketing standpoint, moving on to virtual events and activations digitally, and that seems to be working.
I mean, the digital thing, it was amazing. I was reading some of the things, Aperol was one of the best-selling products during lockdown on Amazon in the UK, even ahead, I think, of toilet paper. We were doing some of the research on that. Because you're now online, what did you learn about selling directly online?
Well, first of all, our online sales are growing triple-digit, and you need to bring the world of the brand into it. You need to do your storytelling well and increase the appetite appeal. And once you do that, then you tie it up also with educational initiatives where you try to teach and help consumers on how to prepare the perfect serve, then you clinch the deal.
Is there a danger? You've done exceptionally well at getting people to make cocktails at home. Does it mean that further down the road you have to offer discounts? Is that one of the biggest concerns that you're looking at?
No, I don't think so. At the end of the day, you got to remember that the cost of a cocktail at home is probably a quarter of what it is in the on-premise. So there isn't much of a pressure to discount.
Traditionally, Bob, I know you spent quite a lot of on marketing also to get the Aperol brand in the places where people go to the beach. Has COVID-19 actually impacted that?
Well, yes. We've canceled all of our, activations in the on-premise and around beaches, etc. There's not much we can do about that. But we can get them, everybody still carries a mobile phone with them, and we can reach them very effectively that way.
What does it mean for example, the revamp of the Grand Marnier brand?
The Grand Marnier brand as well has moved online. It's very digital at the moment, and we're, talking up the grand life you can have at home with the right cocktails. And, personally, last night I fixed myself a great Grand Margarita to celebrate the results, and people are picking this up as well. If you look at our off-premise sales in Grand Marnier, they're growing at a solid double-digit in the U.S., which is its largest largest market.
How cautious should we be on wholesaler restocking? When do you see that happening? How difficult is it for you to gauge exactly when wholesalers will be back?
Well, I mean, the wholesalers are buying, but as they're buying less than they would have in the past, and they're driving down their stock. And I think that is normal in this environment. You got to bear in mind that about 20-25% of on-premise outlets haven't reopened, which obviously creates credit issues and collectible issues for wholesalers. So they've got to maximize their cash generation, and they're doing that by squeezing inventories.
Amongst all your products, you know, what can you tell us about Champagne Lallier? So this is something that you've bought quite recently, Bob. Is there going to be less demand for champagne as people have left celebrations face to face?
Well, that is what we're seeing. I mean, the champagne market is expected to decrease by about 100 million bottles this year. Having said that, you know, we bought the brand for the long term. It's still quite a small brand. It sells mostly in Michelin star restaurants and really high-end bottle shops. It's a small volume brand, and we still think that in this environment we can grow it.
How much can you grow it?
We'll see. I mean, we closed the deal at the middle of June, so we're getting to know the operation a little bit better. But I think, you know, high single digit should be feasible.
You've recently said that you see further large-scale M&A in your industry. Will COVID-19 actually, you know, put a stop to that, or delay it, or actually accelerate it?
Well, I think COVID-19 will probably make a lot of mono-brand owners reflect upon their future. Clearly, if you're part of a well-diversified portfolio, which is well-balanced between the on-premise and the off-premise, you know, you have much better chances of weathering the financial crisis coming out of it.
Bob, we've talked a lot about diversity, especially in the last 6 months. What have you learned about diversity, and how do you look at it differently for Campari?
Well, you know, diversity for us in Campari is not, you know, your regular diversity where people think about, you know, sexual inclination, gender, religion, race, etc. We also see it a lot, and most importantly, in terms of diversity of thought and diversity of style, and that has clearly benefited us during the lockdown because we were able to really interconnect all of these great brains we have in the company virtually and come out of it and make the best out of it.
But will it change your view on you know, the more traditional ways of measuring diversity, or are there any efforts to do on that, and how do you measure it?
We do that, and clearly, you know, as a company is growing and becoming more international, it's becoming much more diverse. I mean, we've really come a long way in the past 10, 15 years. Having said that, we pay particular attention to diversity of thought.
Bob, when you look at Campari, what have you learned about Campari during the lockdown?
You mean the Campari brand?
The Campari brand, yes.
Yeah. Well, actually, the lockdown surprisingly has benefited the brand because, you know, its #1 cocktail is the Negroni, which people were consuming in the on-premise without necessarily knowing that the main component, the component around which the cocktail is built, is Campari. So, as I like to say, no Campari, no Negroni, and we've made that our mantra and really leveraged that by our educational efforts and taught consumers to prepare their own Negronis, and we see Campari accelerating very, very nicely.
Thank you so much for joining us today. Bob Kunze-Concewitz there, the Chief Executive Officer of Campari Group. Now, we're also getting a bit of breaking news out of Hong Kong. This is second quarter GDP coming in down 9%. Now, the estimate was a minus 8.3%, so it's even worse than expected. Hong Kong, of course, being hit by COVID-19, before that being hit quite aggressively by protests, and then since we've also had that security law being imposed by China. Up next, Sanofi and GlaxoSmithKline agreed to supply the UK with up to 60 million doses of their experimental coronavirus vaccine. We'll bring you the latest on that. This is Bloomberg.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, Sanofi and GlaxoSmithKline have agreed to supply the UK with up to 60 million doses of their experimental coronavirus vaccine. Now, this comes as governments around the world race to gain access to a potential cure as fears over a second virus wave in Europe take hold. Now, for more on all of this is Sam Fazeli. He's Bloomberg's Intelligence's senior pharmaceutical analyst, and we're always delighted when Sam can make time for us. Sam, first of all, Sanofi reported results this morning. What were your key takeaways from that?
Yeah, and good morning, Francine. The results were a little lackluster to our eyes anyway. On the surface, it looked like a beat and they raised guidance, but that's entirely due to a exceptional gain they made with the sale of an equity stake, a pretty chunky equity stake in Regeneron, US biotech company. Without it, the quarter would have been a miss, and then the guidance is actually lower than the extra gain they made on the equity. So they've actually, underlying guidance, they've kind of reduced that a little bit. So not particularly great, but obviously the overshadowing element here is the fact that they've got this deal with the UK government.
Yeah, so how big a deal is this? I mean, you have, is it the right thing for government to spend that much money? I mean, there's no kind of guarantee that this will come up to anything, right?
Yeah, it's a very good question. I don't know how much money they've spent, number one. And number two, if it's like the deal that Pfizer did with the U.S. government, the $1.95 billion the U.S. government's going to give them is contingent on the successful completion of a phase 3 trial and the delivery of 100 million doses. So this is not free money being handed out. These are, in this case, I'm pretty sure it's also contingent on delivery and success in phase 3.
Thank you so much, Sam Fazeli there with the very latest on pharmaceuticals, and we'll get an update from Sam throughout the day. Now, Barclays traders had a blockbuster second quarter, offsetting the British retail turmoil caused by the coronavirus pandemic. The bank's securities division reported a 60% gain in foreign exchange rates and credit trading revenue. The lender also took a £1.6 billion charge to anticipate bad loans from the crisis, slightly higher than expected, bringing the total to $3.7 billion so far. Well, here's what the chief executive Just Daily had to say.
Clearly, there's been an extraordinary economic contraction globally, but particularly in the U.S. and in the UK, our two principal markets. We've taken a sizable impairment reserve, £3.6 billion for the first half, including the £1.6 billion in the second quarter. The vast majority of that are derived by our risk models, where we put economic forecasts into those models, future unemployment rates, future GDP rates, spend growth, et cetera. And those models produce those impairment numbers. And we think we have been conservative to build proper impairment reserves. Let's see how the economies, particularly in the UK and the US, unfold in the next couple of quarters. But we like the comfort of having strong impairment numbers, but yet at the same time maintaining profitability for the bank.
Jess, good morning. I'm looking at your investment banking business. Absolute massive beats really across the board. Fixed income up 60%. The estimate was 30%. Equities trading up 30%. Estimate was 3%. The question is, could Barclays keep this up?
We've had, I think, very good performance in our markets business over the last couple of years, and clearly in the last couple of quarters. I think, like all the banks that have reported thus far have commented on, the volatility in the first two quarters were quite exceptional this year. And I think people are expecting a degree of normalization. But as you mentioned, with our fixed income, credit, and currency trading up 60% for the second quarter, then up 80% for the first half year overall, I think we're gaining market share. We want to stay open and available for our buy-side clients, the insurance companies, pension funds, et cetera, that underscore the capital markets. But I'd also say that I think what we're seeing is, in part, the result of a lot of regulatory changes over the last decade. If you go back to the crisis of 2008, 2009, it was really based on bank balance sheets getting into trouble. what I think governments have properly done is they've really moved the focus of financing economic growth from banks to the capital markets, to companies issuing debt and equity, and to firms like pension funds and mutual funds buying those securities. That's really the story, I think, of the first and second quarter, is the resurgence of the capital markets led by massive amounts of liquidity provided by central banks. And I think that has proved to be a fairly constructive response to the pandemic and the consequential economic crisis.
I wanted to ask you about the dividend. I know the report says you'll have discussions about it towards the end of the year, but are you talking to the regulator about bringing the dividend back?
You know, I think what we have all settled on, and I think the decision around the dividend earlier on in this year, given the enormous economic uncertainty we all faced, is understandable. We don't know what the second half is ultimately going to mean for the economies and for the bank itself. I think the current program to move out to the fourth quarter of 2020, discussions about dividend payments in 2021 is prudent, and so we'll have those discussions with our board first and foremost, but then also with our regulators. So I think we're going to leave it to towards the end of the year to try to make a determination as to reinstating our dividends next year or not.
Well, that was Jess Staley, the chief executive of Barclays, speaking to us a bit earlier. Now, coming up, the Bank of Greece's governor sees a major boost to the Greek economy from the EU's historic rescue plan. Don't miss that exclusive interview. That's coming up next, and this is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just...
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, Greece's central bank governor sees a major boost to the Greek economy from the European Union's historic rescue fund agreed this month. Yanis Tornara spoke exclusively to Bloomberg from Athens.
there is not a lot of visibility now. So I would hesitate to make a guess at this point. It will not be small, but it will not be large. I think that's the estimate we have.
Okay. Today, the European Central Bank extended the ban on banks to pay dividends at least until January. Do you think that this decision will make investors more worried? Is it in the right direction?
Yes, it is in the right direction. It contributes to the conservation of capital buffers, and I think it is good for the investors. Investors should not worry about that.
Do you see the need for a further extension of the measure in 2021, or you think it's enough until
We'll
then?
see. That will depend on the evolution of the pandemic. Still, the risks are on the downside, so let's wait and see.
Are you afraid of a second wave of the pandemic?
Maybe yes. In the last 4 days, we have 1 million cases worldwide. So perhaps we are in a second round already in certain areas of the world.
And following the EU's decision on the recovery fund, to what extent does that ease the pressure on the ECB?
It is good for monetary policy because it makes the policy mix more balanced. Monetary policy, it is not almighty. It had a very positive contribution, but it needed the action of fiscal policy as well. So now we have fiscal policy, both on the national sides, but also at the European level, which is very positive. It's temporary, but I hope that it will become permanent at some point. And this is a step in the right direction. Perhaps it's a harbinger for more changes in the future, like the completion of the banking union.
And anything after the banking union, what else could be the next step?
Well, for the banking union, we need to establish the European Deposit Insurance Scheme. Then perhaps we should look for a safe asset and a permanent fiscal tool at the center of Europe.
Okay. Now, on your proposal for a European bad bank, it hasn't caught on so far. Do you still think that the rise in NPLs will be that large that there needs to be a European public sector solution? And if the bad bank is not materialized, what could be the alternative?
Well, I think we should look at the banking sector problems closer. For Greece, we have a very large volume of NPLs, which is about 37% of total loans as a legacy of the past. So Greece is a rather separate case here. For all other member states, the legacy volume is much smaller. So for Greece, it's true that we are preparing an asset management company to facilitate the solution of the large volume of NPLs. And the way we plan to do it will be a win-win situation. It will be positive for all stakeholders, the banks, the state, and the borrowers.
Well, that was Greece's central bank governor, Yanis Stournaras. Now, we're just getting some breaking news out of Heathrow. First of all, Heathrow has said it has set up a testing facility at Terminal 2. That's according to the chief executive. It's also saying that they have had more engagement from the government on COVID testing. And in general, they just seem to say that actually they set up a testing facility and they could start early September if the UK gives them the go-ahead. Now, Bloomberg surveillance continues in the next hour. Tom Keene joins me out of New York. Of course, it's Fed Day. Don't miss our special coverage, also from 7 p.m. London time. Coming up shortly, we'll look at the markets and we'll look at treasuries. This is Bloomberg. another day of risk off across the financial markets. We bring you special coverage of all the price action and implications. Extending lending, the Fed prolongs 7 of its 9 emergency programs until year-end in its latest effort to support the economy in Washington. Stimulus talks stall. Trading boost, Deutsche Bank posts a smaller profit after its best FIC performance in almost 8 years. The CFO tells us the lender is working towards breaking even this year. And profit at Barclays plunges. The British bank warns of a challenging second half of 2020. This is Bloomberg Surveillance, everyone. Tom and Francine from London and New York. Tom, a lot of the focus, of course, will be on exactly what we're expecting from the Fed. I'm looking forward to your special Fed coverage. That will give us a good indication, on what markets are focusing on. And then we also focus on tech stocks.
Well, there's going to be a tech stock ballet today. There's no question about that. It's going to really be interesting to see what the tone is company to company. I would particularly watch Mr. Bezos of Amazon. But you're right, the 2 p.m. Discussion here with Chairman Powell. Michael McKee will be on top of that for us. Caroline Hyde leading our Fed coverage. And all I can say, Francine, is the meeting is scheduled to be a yawner, which means all my radar's up.
Yeah, I agree with that. Tom, we'll have plenty more on that and the impact on treasuries. But first, let's get straight to the Bloomberg First Word News. In New York City is Ritika Gupta. Hi, Ritika.
Morning, Francine, Tom. Senate Republican leader Mitch McConnell insists that businesses, schools, and other organizations be protected against coronavirus lawsuits, and that's bogged down talks over a new stimulus package. And McConnell is demanding that changes to liability law be included wholesale in the legislation. House Speaker Nancy Pelosi says that shows he's not serious about reaching a deal. Federal Reserve policymakers will turn their attention on how to jumpstart a stronger rebound from the recession. They're all but certain to keep their benchmark overnight rate unchanged when they wrap up their 2-day meeting today. The Fed releases a statement at 2 p.m. New York time. Fed Chair Jerome Powell holds a news conference 30 minutes later. And Amazon CEO Jeff Bezos plans to tell Congress today that his company is an American success story with a relentless focus on customers. According to prepared testimony, the world's richest person will strike a patriotic tone for his appearance before the House Antitrust Subcommittee. Bezos will be joined by the CEOs of Facebook, Apple, and Google parent Alphabet. And the UK may loosen up its coronavirus quarantine rules after a backlash from tourists, airlines, and Spanish authorities. The government may abandon blanket curbs on travel to entire countries in favor of regional restrictions. Plus, the amount of time passengers have to stay in quarantine after arriving in the UK may be shortened. Meanwhile, London's Heathrow Airport ramped up pressure on the British government to begin virus testing for arriving passengers. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Equities, bonds, currencies, commodities. A really nuanced data check today. Futures giving a lift with the VIX back to 25.18. Dollar weakness, and it's a way that the dollar is weaker, which is really interesting. All of a sudden, yen catching up with the euro strength. We've got yen strength. You see that in a euro-yen that's churned here as yen does equally as well as euro. All in all, what really is interesting, Swiss franc does nothing, which I think is fascinating. Maybe we'll touch on that with Gilles Moek here in a moment. And Francine, I really would point out Turkey is a mess. Not only dollar lira, But just as importantly, euro lira is out to new record weakness. Turkey, all my radar is up as we roll into August on the challenges of Mr. Erdogan.
Yeah, I think, Tom, you've really been leading, actually, some of our thought process on Turkey and our coverage, and I think we should spend a bit more time on it. Now, stocks are edging up. To be honest, when I last checked, they were kind of trading sideways, Tom. This is because they don't really know what to do in the run-up to the decision from the Fed's policy meeting. We have a couple of banking stocks down. For example, Santander reporting a historic loss. Barclays also had bad loan provisions that exceeded market estimates. Gold hovering close to its record $2,000 an ounce. And actually, Bitcoin, I wish I put Bitcoin. I'll talk about it in a second, but it's steady just above 11,000 as the two asset classes, gold and Bitcoin, seem to be taking a breather today after 8-day rallies. Now, joining us to talk about the economy is Gilles Moek, AXA Chief Economist. Gilles, as always, thank you for joining us. When you look at, the number of infections rising, what does it mean for how you're expecting the recovery to pan out?
Well, my impression so far is that it's not so much, or it's not just about the number of infections. It's about our tolerance to risk. And if there's a big difference between the US and Europe, it's clearly that for any given rate of propagation of the virus, Europe tends to take restrictive measures faster. So here we are. We've already had some regional bans on travel, or strong advice from governments against traveling to some regions. More restrictive approach in some places. However, at the same time, my impression is that we've been able so far in Europe to avoid by a fair amount any return to the complete lockdown situation we had 2 months ago. So I'm still quite positive, actually, on the pace of recovery in Q3 in Europe. July is already in the bag, so to speak. August could be a bit more challenged, but the level of normalization that we have, the pace of normalization, if you believe the real-time indicators, for instance, still puts Europe ahead of the US. So we need to monitor this very cautiously. Clearly, it's not as strong, as stellar as it was 2-3 weeks ago, but the track remains fairly positive.
So what do you worry about the most in Europe? Is it unemployment, or is it something else?
Yeah, I'm not too worried about Q3, because the story about Q2 and Q3 is really about supply side conditions. It's about how far we had to restrict activity in Q2, triggering a massive recession, and how quickly we can normalize supply. When we get to Q4, this is when demand is going to be key. And unfortunately, what we know at the moment is that the picture we get on the labor market is completely artificial. The unemployment rate we have today in Europe has absolutely no connection with the reality on the field, because we've frozen the system thanks to very, very generous part-time unemployment schemes. And we know that these schemes are going to become less generous, usually from October onward. So yeah, Q4 could actually be the sort of proper trial of demand. And unfortunately, I continue to think that we should see moderation in growth as we get to the end of the year.
Jill, you went right to where I want to go. I've been really thinking about this. And Jill, this is the geometry of the microeconomics of the labor economy. And as you well know, and there's been a lot of this in the press, folks, particularly about stimulus in Washington, it's the demand for labor. Is it there?
I don't think it is really there, in the sense that if you create a situation where you subsidize very, very heavily, either keeping people on the payroll or rehiring, you are creating an artificial situation. And my focus is really on the sort of underlying pace of activity we could have towards the end of the year. Usually, there is a strong connection between labor demand and capex. Both factors basically tell you whether companies believe in the future, want to invest in the future, want to be able to produce more. Capex, I think, is going to be really a victim of the current situation, because uncertainty remains too high. And if there's no investment, there is likely to be also a slowdown in labor demand.
Well, you know, Joe, what's so important here is it all falls back into wage dynamics, and it can be, folks, what's called elasticities of demand and supply. And, you know, all this is nudgy microeconomics. But the bottom line is, do we follow on in Q4 from challenges to labor demand? And I love your idea of a CapEx diminishment. And then does that fold into a wage flattening, which leads us into true disinflation?
That's absolutely the risk. And if I look at the way fiscal stimulus is framed, if you want, and the differences between Europe and the US, what makes me a bit nervous is the amount of money that had already been spent in the US to prop up income, to replace wage income, to the point that as of the end of May, aggregate income in the US was actually higher than before the pandemic started. Whereas I really think what we need is support for income in the long haul. And obviously, the more you spend during the emergency, the harder it's going to get a political support for long haul stimulus in the next 2, 3, 4 quarters, which is, I think, what we'll need. And if it's not about supporting consumption, supporting income directly, it's going to be about propping up investment. Again, if the level of uncertainty is too high, you need to replace unused capacity, you need to replace investment in the private sector that is not going to happen with something else, and that could be public investment. And for the time being, when I look at the situation in the US, I'm amazed by how short-termist it still is. It's about propping up demand right now. Might not be the issue, or it's only part of the issue. The issue is to create expected demand for the next 2, 3, 4 quarters, and we're not there.
So, Gilles, what will be...
Okay, order placed and already executed for euro at 117,495. So order placed, and it's short order. I placed short order and we already sold short euro at 117,495.
Are focusing on providing support between now and November. I understand this, but as long as there cannot be a sort of national conversation across the two parties, and it's going to be extraordinarily difficult in the current environment, we're not going to be talking about the kind of support that we have next year. And one of the reasons we cannot really talk about it is that we don't know who's going to win. And the choices will be very different across the two parties. And from that point of view, actually, I think Europe is in a better position than the US. Our problem is that we're still a bit shy, we're still a bit hesitant on the quantum of policy support, on the quantum of fiscal policy support that we are ready to put on the table. That at least from a political situation, we're in a much better position because we can, at the moment, have a conversation and start thinking about 2021, which is not really an open avenue in the US.
Gilles, thank you so much. Gilles Moët there of AXA stays with us. Now, stay with Bloomberg also for special coverage. The Fed decides. That's at 2 p.m. in New York. That's 7 p.m. in London. And this is Bloomberg.
you see coming. Some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
It is a Wednesday in July. Francine Lacroix in London. I'm Tom Keene in New York. A really, really interesting time taking economics here, folding it into finance and investment. Futures up 5. We're looking at dollar weakness right now. Euro 117.51. Yen breaks a 105 stronger. 104.93. Adam Cole at RBC, I thought yesterday, extraordinary on his 10 big figures, strong yen call out to a 95. Right now, we're smarter with Gilles Moak of AXA. Thrilled he could be with us today. Gilles, I want you to look at the basic ratio, which is stimulus to GDP. Just the amount of oomph of Europe, Lagarde, all the other names, America, whatever. Who's getting the stimulus as a percent of GDP best?
The U.S. by a large amount, and there's no question about this. The U.S. response has been swifter, bigger. But coming back to my previous point, it's not just about the quantum; it's about the quality and the sort of visibility or predictability of what you're doing. And for this, you need to start preparing not just for the next 3 months, but maybe for the next 3 years. And this is what's missing in the US. So if I had to provide a caricature of the situation, I would say the US is spending a lot, possibly a bit too much at the moment and not enough in the future. Europe is starting to talk a lot about spending about the future, but is not spending enough at the moment. So we are sort of mirror image across the Atlantic.
The stereotype, or I guess the cliche, if you will, is the bridge. It goes out. Where does the Moak Bridge go to? That sounds like a bridge, folks. It's over the River Seine. It was just after Napoleon's time. Gilles, the Moak Bridge, is it out to 21? Or are you building a bridge out to 2024?
It gets us to the Recovery and Resilience Fund that Europe has just built. It's supposed to take us until 2027. So we are providing visibility on fiscal capacity until 2027. My feel is that it's too slow in the sense that I would be happier with a much more concentrated fund over the next 2-3 years, let's say until 2023, 2024. But for political and technical reasons, this was not possible. And I would go for something bigger because the Recovery and Resilience Fund, for many reasons, remains small. But in terms of timing, this is probably what we need to start thinking, because I'm trying to think about when the market is going to start really questioning public debt trajectory. And I think at some point, when it may take 2-3 years, we may have the return of inflation, or at least of some inflation, which may force central banks to be a bit less accommodative than they are now. It may again take 2-3 years. In the meantime, we can actually front load fiscal spending, fiscal stimulus, without being too nervous about how we're going to fund it. After 23, 2024, I think it's going to be much harder. So this is how I would frame it. Let's use the window of opportunity that monetary policy is offering us. It may last 2-3 years, because if we don't spend now on these 2-3 years, and we decide to do that later, it will be with much more complicated conditions on the financial side. Yeah. So that is how I would describe the bridge. We need to find the right way between the moment when monetary policy is going to start being less supportive than it is today.
And Gilles, do you see European countries, certain European countries, actually doing it wrong or thinking about this wrong right now?
I think on the sequence, it's probably the right approach. It's on the quantum that we have a problem, in the sense that There is a lot of thinking going on now in many countries. In Germany, clearly, is probably the most advanced on this. Also now in France and also in Italy on describing, providing fiscal visibility for 2021 at least, and possibly 2022. So we're getting the sequence right. I think where there is still a hesitation is on how far we can go in the next 1 or 2 years. I think a lot of countries are worried about squandering their fiscal credentials, even though the ECB is helping. And I think there's a sort of habit that we've created in the last 10 to 15 years. It's very, very hard to change a mindset when for years you've been thinking about trying to keep your house in order, trying not to fall in the same trap as many peripherals fell into. So I think we're still a bit guarded in our approach. We've got the right sequence, but we're still a bit too guarded on the quantum.
This has been a very thoughtful discussion. Gilles Moec, thank you for starting us strong in this hour. He's with AXA, their chief economist, on this Fed Day as well. Coming up later, a conversation with Anthony Fauci, an important conversation, more than timely, starting with the horrific new statistics we're seeing out of Arizona leveling, and particularly a new leg up in difficult statistics in Texas and South Carolina. This is Bloomberg.
Opportunity knocks at the door. Don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacroix.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
The national security bill was passed by Chinese lawmakers. The Hong Kong police force has already acted in accordance with the new law.
It's a very disturbing development.
This is, in effect, an attempt to end one country, two systems.
The central government is telling us just stay out of politics.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Rishika Gupta. Let's get the Bloomberg Business Flash. Deutsche Bank's turnaround got another boost in the second quarter. The German lender reported the biggest gain in fixed income trading in almost 8 years. It rose 39% from a year earlier. That offset weaker revenue in Deutsche Bank's asset and wealth management. It's the biggest blow yet to a European bank from the coronavirus pandemic. Santander took a $14.8 billion impairment due to the health crisis. Slumping economic conditions forced the Spanish bank to cut its goodwill on past acquisitions. Even before the pandemic, Santander had the highest loan loss provisions of any European bank. And shares of Barclays are falling after second quarter results. Analysts say the British bank's outlook is cautious. Barclays had higher than expected impairments, and results from the bank's UK and credit card businesses were seen as disappointing. And that's your Bloomberg Business Flash. Francine, Tom?
Ritika, thanks so much. The data check today is really interesting. We've got futures lifting here, and it's on tech. There'll be the tech soiree later today. Paul Sweeney's going to stop by and make us smarter on that. Yield churn with a little bit of a higher yield. Francine mentions gold, 1974 the ounce. On COMEX gold, there's different gold quotes. That's the one I use, COMEX gold here in America. Dollar weaker, that gets noted. And I'd also note just moments ago, Euro lira breaking out to new lira weakness. You need to watch that tick by tick in the world of Damien Sassower. Francine?
Yeah, Tom, I'm looking at stocks fluctuating, the dollar slipping in the run-up to the decision from the Fed later on. Banking stocks, I'm looking at Barclays, which actually had bad loan provisions that exceeded market estimates, but also Banco Santander reporting a historic loss. Both are down. Gold, close to its record, $2,000 an ounce. Bitcoin, I think you mentioned it as well, a steady just above 11,000 as the two assets seem to be taking a breather. And then actually I also put WTI, so West Texas oil, steady pretty much near $41 a barrel amid expectations for higher U.S. crude stockpile. So we'll also have a look at that. Now, we also have Hong Kong covered. We had some GDP figure earlier on that was worse than expected, and we look at the political situation. Be sure to tune into Bloomberg's special on Hong Kong. It's called Hong Kong on Edge 2. That's at 7 p.m. today in New York, and then airing again throughout the weekend. This is Bloomberg.
Quand on voit la mort de George Floyd, on image la mort de mon petit frère Adama Traoré. Et la France va dénoncer tout de suite ce qui va se passer aux États-Unis. Nous, dans le combat vérité-justice pour Adama, vraiment dans le court terme, ce qu'on attend et ce qu'on exige surtout, c'est la mise en examen des gendarmes, la condamnation des gendarmes et d'un procès public. Aujourd'hui, on dénonce le déni de justice qui est en France depuis 4 ans. tant que nous sommes là, nous n'avons pas peur. Ils ont les armes. Nous sommes devenus des soldats malgré nous. Hein. Face à nous, c'est une machine de guerre qui n'a ni sentiment, ni état d'âme, ni remords. Oui, c'est un mouvement qui se prend, c'est le mouvement du comité Adama, de la nouvelle génération Adama. Aujourd'hui, moi, je suis là, nous sommes là. On ne changera peut-être pas le monde du jour au lendemain, mais on changera des choses.
Working on the strategic future of the company. We're long past the stockpiling phase now in North America, and what we're seeing is big shifts from category to category. So things like hand hygiene growing very quickly.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, Tom, Deutsche Bank has reported the biggest gain in fixed income trading in almost 8 years, and we've been speaking to the company's chief financial officer. Here he is.
We're pleased with the performance in our investment bank overall, which is up about 52% ex items, and the FIC business is up 46% ex items. Within that, we have trading businesses, which are rates, FX, emerging markets, which, as you've seen with our peers, are up significantly year over year. In our case, a little over 75%. And in the rates complex, we've now doubled our performance year over year for 3 straight quarters. So very pleased with that performance. Of course, part of it is participating in the better market opportunities that have existed in the second quarter, and we do expect a normalization of that. But you need to remember as well that in our case, we've been working to stabilize, grow the franchise, recover some market share. And so what we're pleased to see is that underneath that sort of outperformance in the market environment that we've been in, we've seen really good franchise stabilization, traction, client engagement, and improvement in client flows. And so we do think that that bodes well for the future.
As I said, you are expecting slightly higher revenue for the full year. Is that not too conservative now, given what we've seen in the first half?
Well, it would be a normalization relative to the first half, but I think an improvement on last year's second half. Again, especially in our businesses, where a year ago we were going through a restructuring and there was some uncertainty around sort of our people and franchise. And so with that now behind us, we do see momentum in the core business, and we'd like to see a second half performance, well ahead of the last year's second half, but we'll see how the conditions evolve. As we all know, we are in a period of real uncertainty, and so while that's led to revenue opportunities, it can also lead to more muted markets.
You are currently looking at Wirecard to see if there are any parts that are worth acquiring. So far, what you've seen, do you like what you've seen so far?
Look, I'll speak generally about the payments business. I don't want to comment on specific events in the marketplace, but payments is a big business for us across a number of our segments, and of course the corporate bank in particular is a very large payments provider globally. We are and have been investing in our merchant services capabilities, and we'll continue to pursue that. As we see opportunities in the marketplace, we may well look to accelerate that growth inorganically, but it would have to fit well with what we do. It would have to be additive to shareholders, and we like how we're executing on that business also organically. The other thing is we're able to do a lot in partnerships. So you may have seen a few days ago we announced an investment in a company, TraxPay, which we're very pleased about. It does supply chain financing capabilities, and so adds to what we can do for our clients, sometimes in partnership. So we're pleased with the opportunities as well as the prospects to grow our business.
So would Wirecard Bank fit the pattern that you just described?
Well, it's hard to tell. I mean, certainly, again, merchant services is a business that they were in, and is one where we feel there's room for us to grow. But I don't want to kind of comment on any specific developments.
The gentleman from Deutsche Bank there, smart conversation with the head of our German bureau. Right now, this is a real joy. If you come out of college and you get to work with a giant. That is really cool. Ronit Ghosh came out of Oxford and had the privilege of working with Mr. Heath. Mr. Heath was definitive in Parliament, and that is an extraordinary opportunity. He's taken that experience and leveraged it forward in the banking and securities analysis business. Ronit Ghosh is, of course, with Citigroup and head of all of their bank research. Ronit, I've got to rip up the script. What was it like working for Sir Edward?
Thank you for inviting me to your show. It was a great experience. I was 21 years old. I was straight out of college.
Unbelievable.
I didn't really know what I wanted to do in terms of my career at this stage. Unlike kids today, I didn't have a grand plan, and I was really interested in current affairs. And I saw an ad in the newspaper and applied.
To our American audience, the only equivalent I can think of in America is the privilege of working for John Quincy Adams on the back end of his extraordinary life. Let's talk about European banking, Ronit. I have looked at the 10-year and 20-year track record of these disasters. Do they care about the shareholder?
Yes, they do care about the shareholder in terms of the management. The senior leadership of these banks do care about the shareholder. When I started in the industry in the mid-1990s, without dating myself, that was just about the start of a revolution. If you went back to the 1980s, you could definitely make the argument that most European banks were run not for shareholders. In the 1990s, you saw the start of the shareholder value revolution in Europe. Since the global financial crisis, obviously banks have to manage many stakeholders. I would hate to be in their shoes. The senior management of these banks is very complicated. And a combination of factors, including, of course, the low interest rates and the burden of regulation, and importantly, the lack of growth, has burdened European banks much more than their U.S. counterparts.
Ronit, does COVID-19 actually change that just because of the level of interest rates in the U.S.? Is there a slightly more level playing field between the U.S. and Europe?
Yes and no. It does level the playing field in the sense that when you look at, for example, estimate changes and expectation changes, of course, drive share prices. Share prices for the U.S. banks on aggregate in the last few months have moved somewhat similarly to the European banks. It's just that their starting points are much worse. So Europe didn't have as many, or the Eurozone specifically, didn't have as many downgrades from interest rates falling as they did in the UK or in the US. But the problem for the Eurozone banks is that it's like we're all catching the proverbial flu, right? The economic flu here. But you're starting with pre-existing conditions in Europe. You're starting with a much weaker position compared to, say, Scandinavia, if I can detach Scandinavia from Europe, and the US. So Europe starts, or the Eurozone and the UK goes into this pandemic with returns that are somewhat similar to the Japanese banks or thereabouts. So you get hit by the weakness, your relative weakness of your existing profitability. That's what hurts you, pre-existing conditions.
Ronit, we talk a lot about possible mergers and acquisitions in the banking world. How close are we to getting something significant, maybe cross-border in Europe?
So there's been definitely an increase in the talk, and specifically the talk from policymakers. We're hearing this much more on a repeated basis from the ECB, from Frankfurt. When you look at, you step back and you look at what drives M&A, though, M&A in all sectors, including in the bank sector, normally happens when managements are confident, when they have a clear view, they have a bullish view in the future. Of course, you can also get distressed acquisitions and distressed consolidation. We've seen a few of those, particularly domestically, since 2008. But really, the heyday of European bank M&A would be sort of starting circa 95, 97, and ending with the global financial crisis.
I'm placing stop on profit for euro at 117.475. Stop on profit for 117.475. Okay.
Are also being buoyed by growth. European banks had balance sheet expansion and growth. Now the challenge, particularly in going into COVID, was there wasn't a lot of growth in Europe or balance sheet growth, and interest rates being low further push down profitability. It's much harder to be bold about the future when you're making 5-6% ROEs pre-pandemic.
Thank you so much, Ronnie Goose there, Citi Global Head of Bank Research, stays with us, and we'll talk a lot more about what the ECB has also recommended on dividends. Now let's get straight to the Bloomberg First Word News. In New York City is Ritika Gupta. Hi, Ritika.
Hi, Francine. Tom. Senate Majority Leader Mitch McConnell has drawn a line in the sand on a new stimulus package. He's insisting that his proposed changes to liability law be included wholesale in the legislation. That's bogged down talks between President Trump's representatives and the Democrats. House Speaker Nancy Pelosi says it shows McConnell's not serious about reaching a deal. Mixed news on the coronavirus pandemic front in the US. Florida reported a record number of deaths, but new infections slowed down in 2 states grappling with outbreaks, California and Arizona. And the positive test rate in Texas fell to the lowest in a month. And the Trump administration and Oregon's governor's office reportedly are in talks about pulling federal agents out of Portland. According to the Associated Press, the state would have to beef up law enforcement in return. Earlier this week, there was talk of sending more federal agents to Portland because of protests and vandalism. And Joe Biden says he'll pick his vice presidential nominee next week, and he told reporters he'll let them know as soon.
Position closed on euro at 117.475, 200 pounds in profit.
And at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. This is going to be interesting. Lawrence Culp, GE Chairman and Chief Executive Officer. Let's put it this way. Danaher up roughly 30% the last 2 years. GE down roughly 30% a year the last 2 years. Their stocks are going in different directions. Lawrence Culp, an update on Generous Electric. This is Bloomberg. Good morning.
Everything around us, including the way we work and live, has been interrupted. Uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Join us for our Bloomberg special focusing on the tensions and turmoil that continue in Hong Kong, a city on edge.
This
This is Bloomberg Surveillance. Tom Francine from London and New York. Now, the ECB has told banks to freeze dividends until 2021. That's an extension of the March move to halt payments until at least October. Now, the ECB says its request has kept about 30 billion euros of capital in the euro area banking system. Well, still with us is Ronit Ghose, Citi Global Head of Bank Research. Ronit, great to have you on the program, and thank you for sticking around. When you look at the ECB recommendations, first of all, I don't think banks are, they're not 100% obliged to follow it, but why should they?
Sure. If the ECB or your national regulator says you need to do something, you tend to do it. Now, in terms of what they've said, there's not really any big surprise for the market that the ECB has said no dividend, no capital return for this calendar year. They previously said there wouldn't be capital return until the autumn, until the fall. It was expected by most people in the stock market this would be rolled forward till year end, and the same by the Bank of England. The Swiss and the American regulators have a slightly different nuanced view, but it's broadly the same. Capital return is quite limited for the Swiss banks and the US banks, and is off the table for the European and UK banks for this year. Next year, different story.
Ronan, I look at Keith Horowitz's buy, hold, sell. It's all of great value. Your wheelhouse is fintech. Fintech to me is like a joke until one panel at Davos, I really got it, how far behind we were. In the pandemic and in the digital disruption that you write about, how far behind is the United States?
The U.S., because of its scale, has everything. So there are parts of U.S. financial services, particularly the capital market side, the B2B side, which is world-class. There are other parts of the U.S. financial system, not dissimilar to the U.K., that has first-mover disadvantage. What do I mean? A lot of what we grew up with in terms of consumer finance, so ATMs, credit cards, those all got built, created in the U.S. and first in the U.K. in the 1950s and 1960s. So the first ATM, London and the U.S. will fight over who had the first ATM. But that meant that when we shifted from that era, that age, to the current digital age over the last 10, 15, 20 years, the US and the UK already had a lot of installed form factors. You go to China, more recently India and Kenya, you don't have so many installed form factors. You do leapfrogging. You go to paying with your phone. You go to using the mobile. And that's why the US in some ways is behind.
We'll have to leave it there. Ronit Ghose, too short a conversation. We look forward to seeing you, particularly at Queen Victoria Street in London. Global Head of Bank Research for Citigroup. It's a Fed Decide special. Caroline Hyde will be driving our conversation forward. Scott Miner to join us with Guggenheim Partners. We look for that at 2 p.m. Stay with us. This is Bloomberg Futures Up 5.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
This is the first major antitrust investigation the Congress of the United States has engaged in about 50 years. The chief evil that antitrust is designed to address is economic coercion. And to the extent that these large technology platforms are behaving like monopolists.
The antitrust issues facing Facebook and Amazon are much different than the antitrust issues facing, for example, Apple. Zuckerberg will get the majority of the ire. Bezos will get the majority of the praise and the idolatry, and I think Cook and Sundar Pichai are just going to stay out of the way.
Google is the only the only actual monopoly. When you have monopoly power, you have to have regulation. And I think in the next couple of years, we'll probably get closer to it than we've ever been.
Sometimes I have negative opinions about Apple being a little too much control over you, but I've thought about this one, this one that's going on right now with antitrust, and I actually take Apple's side on this one.
The use of the App Store, developers who are startups are basically being forced to pay a ransom of 30% or they are denied access to that marketplace. This is 30%. This is highway robbery.
30% and giving you guarantees and protection and security in the apps that you could possibly download. When you look at what happened in the Android world, oh my gosh, yeah, I don't object to the 30% at all.
I can't think of another industry where as large as this industry, $150 billion, where one company has 93% share. Sundar is very likable. I think Google benefits from the fact that it's not an easy business to understand. So I would expect that Sundar and Tim will largely just stay away from the train wreck and the praise that is going to be the Zuck and Bezos show.
What you have just seen there, folks, is why we do Bloomberg surveillance and why we do Bloomberg. That is an extraordinary set of conversations on technology and what we've wrought. Paul Sweeney joins us now. He invented Bloomberg Intelligence. He rarely gets up this early because he's waiting for Bloomberg surveillance at 9 a.m. to provide tech wisdom. Paul Sweeney, the key item there was from Galloway on the market share of Google. You and I remember standing at Park Avenue a million years ago where Google's market share of search was 52% and they would never get to 56%. All these tech companies have grown up. Is it time to admit their monopolies?
It's interesting, Tom. You're right. I mean, these tech companies have just become so important in everybody's daily lives in terms of consumer behavior. They've become absolutely the stalwarts of the stock market. And you just think about over the last 12 months, the performance of the big 4, 5, 6, 7 names that we all talk about. There are all these big tech companies and how they've been just dominating the stock market. And the interesting thing for tech investors is the U.S. federal government has rarely taken a regulatory hand to these companies. It's really been the Europeans that have really regulated or tried to regulate big U.S. tech companies going all the way back to Microsoft 20 to 30 years ago with their software. But now, over the last couple of years, we've seen more and more U.S. regulatory oversight, and it's a question for tech investors. Is this the beginning of, big U.S. regulatory oversight at the tech companies?
Except they're all at the Willard Hotel in that famed corridor where they invented the phrase lobbyist. I mean, come on, these guys are up to their eyeballs in lobbyists in Washington. Have these 4 guys and their brethren, have they just simply paid off Washington?
You're right, Tom. They've really stepped up their lobbying efforts over the last 5, 6, 7, 8 years, these tech companies. And I think the real question is for investors in these tech companies is, do I need to worry about the chance that some of these companies may be broken up? That's the big issue. You don't have to worry about them with
further acquisitions, you have to worry about whether the existing companies could, in fact, be broken up to some degree. And I think most investors today, if you look at the stocks, they're saying that is not a risk. I'm not too concerned about that. So the question today for all the big tech executives and the investors in their companies, is it just theater today, or will something substantive begin with some of these hearings today?
Paul, how would that change under a Biden administration?
Yeah, it's interesting. You think about Trump administration, laissez-faire, deregulatory across a whole host of industries, yet here they are being hauled in front of Congress. The expectation is in a Democratic administration that perhaps the regulatory constraints would be even more pronounced here. But I think, again, most investors feel like the U.S. is not in a position, or does not have the expectation of significant regulation of the big technology here. So again, you look at the stocks, most of them hitting all-time highs here, even despite the pandemic and the impacts on the market. Most investors are telling you we don't think the regulatory risks here are that dramatic for these big tech companies.
Paul Sweeney, thanks so much. I'll see you at 9 a.m. this morning. Mr. Sweeney, of course, founding Bloomberg Intelligence. We've got much more coming up. Fed decides. We'll do that at 2 p.m. But then we've got the tech hearings as well. They'll show up, no doubt, well-dressed. Amazon, Facebook, Alphabet. No! Amazon, Facebook, Google, and Apple. I'm sorry, it's Google. Google and Apple starts at 12 p.m. Today as well. Shortest, soonest, Ellen Zentner, Morgan Stanley, must watch, must listen. Let me give you a data check right now. Futures up 6, Dow futures up 13. The VIX comes in 25.23 sprightly. Turkish lira can't get out of its way. Weaker this morning, and along with that, a weak dollar and strong yen through 105, 104.94. Francine says I have to do gold. 1972 the ounce, up $8. Gold. Interesting. Goldman Sachs with that call of well above 2,000 per ounce on gold. So we've got much more coming up. Seriously, Ellen Zentner with us here in a bit. That'll be a good, important update. This is Bloomberg. Good morning.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Last year, we took you inside the political turmoil gripping Hong Kong. This year, Beijing tightened its position with a new national security law. Will this jeopardize Hong Kong's position as a global financial center? And will China face the consequences from abroad? I'm Stephen Engel. We take a second look at the crisis facing the city in a Bloomberg television special, Hong Kong on Edge 2.
This morning, technology executives, I guess they'll speak to Congress, maybe they'll listen to Congress. Their combined market cap is 22% plus of America's annual economy. They employ 1.1 million people. Translation, well, I saw it on Instagram, then I searched Google, then I bought it off the iPhone. It'll be here tomorrow in a cardboard box. Welcome to America. It is Fed Day. The dollar is weaker this morning. Ellen Zentner is scheduled. And Wednesday, well, it has to be more productive than Tuesday. It just has to. Senator McConnell, they all go in search of, quote, common sense. Good morning, everyone. This is Bloomberg Surveillance from New York, from London. Francine Lacroix and Tom Keene. Francine, a busy day. We got the Fed decides, 2 p.m. We got the technology executives decide, I think 12 noon as well. Boring. What's going on in the United Kingdom?
Well, the United Kingdom actually, Tom, just this morning announced that it will build up its COVID vaccine supply, so we're looking at that. But actually, overall, it's unclear. We spoke to Sam Fazeli earlier, as always, a very informed and interesting conversation. He was saying we don't exactly know how much the UK is paying, and they're paying for this, vaccine supply with Glaxo and Sanofi deal, but we don't know whether they'll have the right vaccine. So many questions just on how administrations and prime ministers get access to these vaccines for their citizens.
The virus dynamics right now, whether it's first wave, second wave, third wave, just extraordinary. I make particular note of the glide path of Texas and South Carolina. Right now, in New York City with our First Word News, here's Ritika Gupta.
Morning, Tom. Francine. Senate Republican leader Mitch McConnell insists that businesses, schools and other organizations be protected against coronavirus lawsuits. And that's bogged down talks over a new stimulus package. McConnell is demanding that changes to liability law be included wholesale in the legislation. House Speaker Nancy Pelosi says that shows he's not serious about reaching a deal. Federal Reserve policymakers will turn their attention on how to jumpstart a stronger rebound from the recession. They're all but certain to keep their benchmark overnight rate unchanged when they wrap up their two-day meeting today. The Fed releases a statement at 2 p.m. New York time. Fed Chair Jerome Powell holds a news conference 30 minutes later. Amazon CEO Jeff Bezos plans to tell Congress today that his company is an American success story with a relentless focus on customers. According to prepared testimony, the world's richest person will strike a patriotic tone for his appearance before the House Antitrust Subcommittee. Bezos will be joined by the CEOs of Facebook, Apple, and Google parent Alphabet. In Hong Kong, the economy shrank for a fourth quarter in a row. The coronavirus pandemic and political unrest extended the city's first recession in a decade. Hong Kong's GDP fell a worse than expected 9% in the second quarter from a year ago. The unemployment rate has risen to a 15-year high. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Equities, bonds, currencies, commodities. It's real simple. Weaker dollar is a lead story here. Futures with a lift as well. It's a genuine lift. I guess I would say VIX in 25.19. Yield comes back over the last few days. But the real story is the weaker dollar. DXY, that blended major trading partner index, 95.94. Settling down right now, 93.50. Even sterling, I don't know, Francine, what's a 130 sterling mean?
Well, they're looking, of course, at Brexit, Tom, and we understand through our own sources that although publicly there doesn't seem to be a way forward in terms of talks, we understand that privately talks are progressing and maybe they're just going a little bit better than expected. So we are looking at pound, we're looking at overall these markets that seem to be fluctuating. I do think, you're 100% right, it's all about the dollar today, gold pretty much holding steady after recent surges, and Treasury edging lower, Tom.
Very good. Tuesday went on script. Kevin Cirilli gave us a terrific brief yesterday on what would not occur on Tuesday. I believe we have 100% certitude that Wednesday follows Tuesday. On this Wednesday, our chief Washington correspondent, Kevin, okay, we went through the ballet yesterday. What's the now what this morning?
Well, Speaker Pelosi is saying that it's a non-starter for Leader McConnell to continue to insist that there be liability protections, Tom, included in the next round of stimulus talks. However, yesterday, I was speaking with some Democrats who seem to be receptive of the idea of having there to be some tax credits for businesses with strings attached to it, particularly strings attached, meaning that there wouldn't be furloughs or layoffs at the end of the year. I think as it moves forward now, and so much of the news out of Washington this afternoon will be on the House hearing with big tech CEOs. But with regards to the stimulus, as it moved forward, I think that the next major development here will be if there's some piece of significant breakthrough. I think it would likely come between the Treasury Department and Speaker Pelosi before it becomes before Pelosi and McConnell.
Who's driving the bus, the White House or Senator McConnell?
McConnell. And I think that that's just based upon the conversation that you and I have had for weeks, Tom, about the political capital from the White House. The lack thereof, that's the perception amongst Democrats. So as a result of that, you're seeing that Republicans in the Senate and in the House are feeling a bit emboldened with their own negotiation strategies in order to move forward. However, quite honestly, and this is just based off of so many conversations I've had on this for the past couple of weeks, I think that Pelosi's camp would rather deal with the Treasury Department than to deal with the Senate, because I think that there's a calculation that McConnell would be able to get in the next couple of days more of his caucus on board with him.
Kevin, good morning from London. I've been trying to keep up to speed with exactly what's going on. Is the divide in terms of what wants to be done bigger between the Democrats and the Republicans, or for example, the fiscal hawks in the Republican Party and the ones that are more moderate?
It's a political 1-2 punch, and I think that the first step, Francine, to getting across the finish line is going to be for Leader McConnell to have to unify his party. Quite frankly, I don't think that the Republican Party as a whole in the Senate, based upon my reporting, would throw a massive wrecking ball into the chances of another round of stimulus getting done by August, by the August recess in the next couple of weeks, really. But once they are able to get the votes, then it will become more of a partisan fight, which is why you're seeing Speaker Pelosi have more of an interest in dealing with Secretary Mnuchin than Leader McConnell.
How quickly can this be unlocked, Kevin?
I think that the next step in the process that I'm looking for is whether or not there is any type of major breakthrough. Speaker Pelosi yesterday saying that the liability protections are something that are a non-starter, but in terms of the process here, we're in the thick of the negotiations. So when there is a breakthrough on those negotiations, I would anticipate that sometime between now and the end of next week. But it's Washington and the drama never stops, so there could be some more theater over the next couple of days.
Kevin Cirilli, thanks so much. Our chief Washington correspondent. Coming up in a bit, a conversation with Mr. Fauci. No, not on his ability to throw out the first ball, on the seriousness of the cases dynamics, the death dynamics of the pandemic in America. Stay with us. This is Bloomberg.
really sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
The fees that retail has had to pay to be able to enter the markets, the democratization of the markets by allowing them to have direct access to the markets over the last 10 to 20 years has really been, a key trend that has driven, I would say, the U.S. markets.
It is about economics, finance, investment. It's about international relationship and politics. And the arc of all that is about labor, about jobs. Francine Lacroix in London. I'm Tom Keene in New York. And right now, Ellen Zentner joins us. And there's like 8 things to talk about. But the one thing, Ellen, that ties it all together for me is the labor economy like you and I have never seen across the time we've been together. What's the unemployment rate going to be into the end of the year and into next year?
So I think that the unemployment rate has come down sharply in a couple of months as we brought a decent chunk of labor back to the market, but it's really slowing. It's going to be very sluggish from here forward, getting more improvement. So we think it's still going to be near 10% by the end of this year, and could be around 6.5% by the end of next year. So still about 3 percentage points by the end of next year compared with where we were going into COVID.
Okay, that's a countable U3 number, but what's the all-in? We spoke to the lieutenant governor of New York State yesterday, and she was heated that the unemployment rate in Buffalo is 16% and really publishing 20%. What's the number above that, the U6 or however you want to measure it, Ms. Zentner?
Well, I think in many areas, Tom, it is going to stay closer to 20% in terms of a complete measure of underemployment. And that's because you're going to have some states that are more heavily weighted toward industries that will be very slow to come back. Those that are more heavily weighted toward leisure and hospitality, toward those discretionary high-density services. Any of those states, not only are the revenue streams going to be weaker, so there will be more layoffs at the state and local level, but there will be less chance compared with other more balanced states in terms of their industry mix that will determine how many folks they can bring back to the labor market and how many jobs they can create on top of that.
Ellen, what do you want to see in the stimulus package that would help with the weakest parts of the U.S. economy?
Well, I think first and foremost, it's a great question, Francine. I mean, from an economist perspective, the help for state and local governments has got to be there. They can't run deficits in perpetuity like the.
I'm placing an order to sell short euro at 117.521. Order placed to sell short at 117.521.
On labor. And so to keep job cuts from becoming draconian at that level, they need help shoring up revenues. On the other side of that, I would focus on the extended unemployment benefits, that federal program, that $600 weekly supplemental. I would love to stop beating around the bush and just extend it. Extend it because the unemployment rate is still in double digits, and this is not the time to try to wrangle and delay in order to get fine-tune the program just right. There's just not enough time for that. It's already expired. We're looking at already several weeks of gap in income for households that they started preparing for in July. We could see that in some of the data coming in the last half, covering the last half of July. So I think we've got to get that thing passed, get it passed. Our public policy strategists think it will happen in the first week of August, but we really don't know the fine details on the contours of that package yet.
Yeah. Ellen, how much more is the U.S. economy actually going to need, longer term? So let's say this stimulus package is approved. What happens in 12, 18 months?
Well, I think it's going to depend on the outcome of the presidential election. An administration starting off in 2021 is going to need to transition away from emergency support in the time of COVID to how can we put in policies that create a sustainable path and sustainable growth for revenues. And so that does mean more spending in order to get that. That does mean something like infrastructure spending that is probably the one thing that does ultimately pay for itself, creates productivity, creates jobs, creates income, creates revenues. And so those kind of sustainable policies means that we are still going to see deficits rise. Even if we go into a regime of higher taxes and such, there's still going to be on net more spending.
And what we heard there from Gilles Moek in the last hour, much the same. Ellen Zentner, I can't believe we've hardly talked about the Fed today, folks. There's so much other news going on. What will you listen for in the press conference today?
So overall, I'm going to be gauging the tone coming out of the Fed. I mean, it's got to be dovish. How dovish is it? Accelerating cases, COVID cases, fiscal policy that's completely uncertain going into this meeting. And there's no pushback on markets they need to do. So I think everyone expects a dovish tone. I'm looking to the degree that it comes across in the Q&A with Chair Powell. Otherwise, we're looking for them to begin that process of setting up a change in their framework we think will come at the September meeting, where they even more firmly tie policy accommodation to economic outcomes. Very firmly saying, look, we're not going to raise rates. We're going to continue balance sheet policies until the unemployment rate gets this low or inflation gets this high. Something more firm that sends the message to markets of just how long policy accommodation is going to remain in place. And the outcome could be very well in September that it remains in place. The message sent is it will be in place for even longer than markets have priced in. So the hints around this are going to come in the Q&A of this meeting. We'll get more information in the minutes. And then I think that Jackson Hole being virtual and open to everyone for the first time is a great time for the chair to preview
well said.
those changes.
Yeah, well said on Jackson Hole. That will be fascinating, usually a very closed meeting. Ellen Zentner with us, and she will continue with us here. Again, so much to talk about the American economy. The Fed decides. Caroline Hyde leading our coverage at 2 p.m. on Chairman Powell. Michael McKee with his expertise as well. This is Bloomberg. Futures up a little bit, up 6.
He said that the idea that China is our competition is really bizarre. Well, watch what happened. Not a good situation. Their freedom's been taken away, their rights have been taken away, and with it goes Hong Kong, in my opinion, because it will no longer be able to compete with free markets. A lot of people will be leaving Hong Kong, I suspect. And we're going to do a lot more business because of it, because we just lost one competitor.
I am canceling order to sell short euro.
The next short period of time, but we can impose massive tariffs on China if we want, and other countries if we want, and we'll see. We just want to be treated fairly. Tremendous amounts of our energy.
I need to restart the streamer. Could everybody who follow my trades just press F5 on your computer in about 30 seconds, okay? Because we're receiving a lot of data, and once in a while I need to restart it. I appreciate it. Thank you.
These technology and telecom providers